My name is Rosemarie Morbelli, and on behalf of all of us at Gabelli Funds, Wayne Pinsent and I would like to welcome you to our 16th Specialty Chemicals Symposium. Today, we have 11 companies participating in this event, both in person and in Zoom. I would like to thank everyone involved for their contribution. Wayne will go over the agenda at the end of his presentation. We encourage everyone to participate in the Q&A, either in person or by using the Zoom program. Wayne and I will now go over a few characteristics of the industry. So, as most of you know, the specialty chemicals world is comprised of a diverse group of companies offering products from adhesives to water treatment with a strong service component. While divisions may compete with one another, in most cases, there is little company-wide competition. They work closely with their customers with a focus on helping them solve problems, become more efficient, and in many cases, lower their overall cost. Furthermore, while specialty products represent only a small portion of the overall cost of a customer's end product, they are needed in order to ensure performance. These companies serve many end markets, which I will cover in a few slides. Lastly, they are part of a consolidating industry with companies looking for new technologies and trends into new markets, geographic expansion, and scale. Sorry, I went too fast. There we go. How did that happen? No. Okay. Sorry. This is what happened when you get gray hair. Thank goodness I have all of the young kids taking care of this thing. Okay, similar drivers. There we go. So, despite their diversity, they are affected by similar factors such as raw materials, many of which are derived from crude oil and natural gas. However, since they are 4 to 6 steps removed from cracking either naphtha or ethane, prices have been historically more affected by specific dynamics such as supply-demand. As a general rule, they do not compete on price, but focus on value instead of volume. They are able to raise prices to fight inflations, albeit with a 3 to 6 months lag. And as global companies, they are affected by current fluctuations and by the global economic environment. Following the end of the pandemic and the start of the war in Ukraine, oil prices jumped from their low of 2020 to a 2022 high. Recently, prices have declined due to several factors: slower economic growth in China, OPEC's production increase, and the expectation of higher non-OPEC supply increase. On the other hand, natural gas prices, which came back to Earth in 2023, has recently increased in response to several things: the cold winter in the US and Europe, which lowered inventories, increased LNG exports, and the expectation of future natural gas demand for electricity generation by gas and electric utilities. As international companies, they are affected by the value of the dollar versus many currencies, including, but not limited to, the euro, the yen, the renminbi, and other Asian currencies, as well as the Mexican peso and other Latin American currencies. Of course, they are all sensitive to global economic trends. The decline in economic activity during the pandemic was followed by a substantial pickup in demand, and the subsequent decline was due to the buildup of inventory during the 2022 supply chain issues. This graph is in line with most companies' view that demand will improve in the second half. However, it does not reflect the impact of the latest layoffs and tariffs, which may result in the PMI decline. And as in 2024, the pickup expected for the second half may not occur. So as you can see, specialty chemicals products are part of our everyday life. While the companies operate in very large markets displayed here, as they work closely with their customers, they often focus on smaller niche areas where they can win by making a difference. And it is clear, looking at the main product lines, that the opportunities are substantial. I will now let Wayne address some of the other topics we will be focusing on today. Wayne?
Thank you, Rosemarie. Hi, everyone. I'm Wayne Pinsent. I'll go over some key themes continuing to drive the industry. Sustainability continues to be a driver of innovation to meet demands from companies, consumer preferences, and regulators. Some of the actions taken include creating more recyclable products to drive a more circular economy, reducing water and energy usage, as well as electrification and lightweighting. There's a strain on finite resources. The global population continues to grow, and more importantly, the middle class is expected to grow by 40% to 4.8 billion by 2030. This will require more food, water, and energy, and as we know, these resources aren't infinite. One important area is water. It's essential, becoming scarce, and demand is growing along with population growth. It's projected to be a $540 billion global market by 2030, requiring a lot of investment in order to face the planet's future needs. The EPA estimates in the US it'll take over $650 billion over the next 20 years to upgrade our water systems, to fix aging infrastructure, lead pipes, and remediate for toxins, including metals and other contaminants like PFAS, which has been in the headlines as an area of big concern. We held 2 conferences on that topic with some of the companies here today and other leaders in the area. We'll continue this theme with companies focused on containment and destruction of PFAS at our 11th Annual Waste and Environmental Services Symposium back here at the Harvard Club in a couple weeks on April 3rd. Infrastructure is another big focus. The IIJA in the US includes $550 billion going towards fixing roads and bridges, improving the electrical grid, and over $50 billion to upgrading the water infrastructure just discussed. Electrification and EVs has been a major focus of both governments globally and automakers, with electrification inevitable in the long term. There's still been strong demand in China, but slowing demand in Europe and the US has led to an air pocket in the market. Due to that slack in demand, particularly from extended production schedules from US automakers, we've seen a plunge in the price of lithium from its highs of around $80 per kilogram to leveling off in the $10 to $11 range. It's led to severe downturns in lithium stocks and the delays and cancellation of many projects. This should bring the near-term supply-demand dynamics more in balance, but we've yet to see a recovery. We'll likely hear more about that this afternoon. So here are the 2025 market trends. So far in 2025, we're having a bit of deja vu from 2024. Almost all the companies are expecting a tepid macro environment to remain in the first half, with recovery in the back half. And that was before a lot of the more recent uncertainty in the market. Companies are looking for clarity on legislation, regulation, and tariffs, and the global trade implications. Inflation and FX headwinds remain a concern. Most reporting companies have been mentioning FX headwinds for the year with the strengthening US dollar, but we've seen a lot of that strength reverse in recent weeks. Questions remain around interest rates and getting comfortable with being in a higher for longer environment, or when the Fed may act. Focus remains on investments in digitization and AI for the companies themselves and to better serve their customers with needs for efficiencies in operations and to offset skilled labor shortages. And with healthy balance sheets, companies are focused on organic growth with an eye towards accretive bolt-ons as the M&A environment improves. So while we're still in a period of uncertainty, we think it's a great time to invest in specialty chemicals. Their attributes include crucial products for customer performance. These are typically low-cost inputs overall that provide critical performance characteristics for customer end products. Investments in developing countries where there's opportunity for share growth, innovations to further penetrate existing markets or enter adjacent markets with higher margin products. Healthy balance sheets remain important, especially in the light of continued higher interest rates, as is a balanced approach to capital allocation, which includes investing for growth, both internally and for M&A, and finally, of course, shareholder return, which includes dividend increases and share repurchases. So here's the agenda. Following this introduction, we're going to start off with a virtual presentation from ARC Inc., followed by BASF Corp. At 9:30, American Vanguard at 10, then Quaker Houghton at 10:30, Rogers Corp. At 11 with a virtual presentation, followed by a fireside chat. Then we'll have Minerals Technologies at 11:30, followed by a break for lunch. And then we'll pick it back up in the afternoon with Chemours at 12:30, followed by Orion at 1, Rayonier at 1:30, a virtual fireside chat with Sherwin-Williams at 2, and then we'll end the day with Lithium Americas at 2:30. We thank you all for being here and your interest, and with that said, we'll get prepared for our first presentation with ARC Inc.
Thanks, everyone, and thanks for the opportunity.
Thanks, Bob. I'll introduce you, and then thanks for joining us. So to
Sorry
kick,
to jump the gun.
no, it's fine. So to kick us off virtually, we have ARC Inc. ARC, formerly known as Advanced Emission Solutions, is headquartered in Greenwood Village, Colorado. ARC is primarily engaged in the sale of consumable air and water treatment options, including activated carbon and chemical technologies. Through its acquisition of ARC in early 2023, the company significantly increased its capabilities in granular activated carbon for water treatment and energy transition in higher growth markets, including applications for PFAS remediation. Additionally, ARC is entirely vertically integrated due to its ownership of Five Forks, a lignite mine, which supplies the primary raw material for powdered activated carbon, as well as its Corbin, Kentucky facility, which supplies waste derived bituminous feedstock for granular activated carbon. The company just completed an ambitious Phase 1 CapEx plan to convert its Red River facility to produce granular activated carbon, while also taking significant measures to improve its powdered activated carbon operations. ARC has around 42 million shares outstanding, trading at $4.80 for around a $200 million market cap, net debt of $11 million for a $211 million enterprise value. Joining us virtually is CEO Bob Rasmus. Bob joined ARC as CEO in July 2023. He's a veteran of our conferences now. Between 2012 and 2020, he founded and served as CEO and director of High Crush Proppants, a fully integrated provider of proppant and logistics services for hydraulic fracturing. He serves on various boards, and prior to High Crush is co-founder and managing partner of Red Oak Capital Management and was president of early stage venture capital firm Thunderbolt Capital. And with that, I'll turn it over to Bob to give us an overview of ARC. Thanks, Bob.
Thanks, Wayne, and thanks, Rosemarie, for the opportunity to present today. I'm not going to do a page flip, so rather than have a disembodied computer voice go through this, I would refer you to our website, arq.com, for our most recent investor presentation, which covers the fourth quarter and full year 2024 results. Excuse me. You know, Wayne mentioned shareholder returns. I'm also going to talk before I start about shareholder alignment. When I was first approached about the opportunity of becoming CEO at ARC, I was intrigued by the opportunity to both transform the PAC business and use that as a low-cost springboard or entry point into the high-growth or high-margin granular activated carbon business. I was so intrigued and so believed in the opportunity, I bought 1 million shares of stock. By the way, I've also added to that ownership position subsequent to becoming CEO. I agreed to take a $50,000 salary and the rest of my compensation based on equity and equity returns. So I'm fully aligned with shareholders and shareholder returns. Quick overview, you know, what do we do at ARC? You know, we're really an environmental technology company whose specialty chemical products, principally activated carbon, reduce or even reverse environmental liabilities such as PFAS or forever chemicals and other harmful pollutants. You know, logical question is, for those of you who don't know, what is activated carbon? Activated carbon is really a largely highly engineered, from our standpoint, sorbent materials which purify, filter, and remove pollutants from air, water, and soil. And when activated under high heat, our carbons adsorb those harmful pollutants. They don't absorb, they adsorb. A sponge absorbs something. The adsorption is the equivalent of when you stick your hand in a box, which comes, and you have all those packing peanuts on your hands when you pull out. That's adsorption. And the activation process, when we activate the carbons, that we're increasing the size and surface area and creating pore space. Think of a kernel of corn that when it's heated and is equivalent of being activated, you have a popcorn kernel which is much larger in area and much higher volume. We produce two types of activated carbon, powdered activated carbon and granular activated carbon. I refer to our PAC business as our foundational asset. The markets in which we sell into is we have a leading market share in the power generation industry, which is principally scrubbing mercury emissions from coal-fired power plants. We also have expanded into the water market, which is improving taste and odor, into the cement market and other industrial and pollution remediation applications. The granular activated carbon market, or GAC, is the growth business. The markets where we have contracted and we are targeting are the municipal water, the removal of PFAS, the specialty gas, the renewable natural gas segment, the food and beverage markets, and as well as the air filtration markets. We're the only fully domestic, fully vertically integrated supply chain, and that has several important benefits for us and our customers. One, it provides product reliability and certainty and quality versus imports. Two, it has us qualify for the Buy America, Build America, which is an important tendering component for many municipal contracts as well as federal governments. And more importantly, we have no exposure to tariffs from importing our products from other areas. In fact, we benefit from tariffs as it relates to that. We've got an undervalued asset base. Our asset base principally consists of our Corbin, Kentucky facility, which we acquired with the legacy ARC acquisition, where we also have some significant IP associated with that, and our Red River, Louisiana facility. Our Red River, Louisiana facility is where we are producing powdered activated carbon, and is where, as Wayne mentioned, we have expanded to be able to produce granular activated carbon. Those assets are significantly undervalued. We have an insurance value of over $500 million on that PP&E. We conservatively estimate the replacement cost at least $700 to $800 million, and we're carrying those assets on our balance sheet. Total PP&E at year-end 2024 was $178 million, or roughly less than 25% of replacement value. We've also transitioned the company to something that is growth-focused, is on that. We're utilizing those foundational PAC assets, people, and relationships as a springboard into the high growth, high margin, and I mean much higher growth, much higher margin, granular activated carbon business. Our product is environmentally beneficial, that we use highly purified bituminous coal, metallurgical coal, waste and tailings through an important IP-protected process at our Corbin, Kentucky facility, where we're essentially taking waste, using that waste and transforming that as the feedstock to be able to create granular activated carbon, which is then used to remediate other waste. So we essentially get 2 bites at the environmental apple. The other important aspect of that IP process and feedstock at our Corbin, Kentucky facility, it results in greater efficacy and efficiency of our product. Our testing and independent testing has shown that our granular activated carbon product produces 8 to 9 times better and is more efficient than the industry standard at the time. We're also well capitalized. At the end of 2024, we closed on a $30 million asset-based lending facility. We used approximately $10 million of the proceeds to replace an existing term loan that predated my tenure at the company. By paying off that loan and entering into the ABL facility, we reduced our debt cost of capital by over 50%, and we also have additional availability over and above that to handle any liquidity or working capital builds in connection with the expansion into the granular activated carbon business. During 2024, we also completed 2 separate stock offerings totaling $42 million. Those stock offerings expanded our shareholder base and certainly enhanced shareholder liquidity. And those 3 items, the ABL facility, the equity offerings, combined with the turnaround of our PAC business from a loss-making enterprise to a positive EBITDA, means we're in a strong liquidity and capital position. We're the only pure-play activated carbon company which is public. We're using our foundational PAC business, as I mentioned, as a low-cost entry point into the higher growth, high-margin GAC business, and we're entering that GAC business with unique IP, creating a superior product quality. Before I go more into the GAC business, I want to talk about the PAC business and specifically the turnaround that we've been able to achieve in the last 18 to 20 months. There's been no magic formula, no magic recipe, no magic elixir involved in the turnaround. It's been basic blocking and tackling. It's creating and transforming the culture. One of the things we've tried to do and emphasize is at ARC, we want to be the safest, we want to be the lowest cost, and the most profitable company in the industry. And our turnaround is focused on profitability. Our gross margin was 36% in 2024 versus 32% in 23 and 22% in 2022. We've had a $10 million swing in EBITDA to $7.7 million positive in 2024 versus a negative 2.2 in 23. And I believe with the turnaround, we've achieved sustained growth and are on the path to sustained profitability in our PAC business. The 4th quarter of 24 was our 3rd consecutive quarter of positive EBITDA. Full year 24, we had a 10% increase in revenue year over year. And importantly, that these products are highly engineered specialty chemicals that are a detailed technical sale. It isn't as if a salesman shows up and says, I can have a super sack or I can have a truckload or a train car full of powdered activated carbon or granular activated carbon. They have to pass rigorous technical and product qualification and testing, and we benefit by, I believe, having the best technological team in the industry, and that also serves as a speed bump to entry for other entrants. We've had 7 consecutive quarters of double-digit increases in our average selling price, including 14% year over year in the 4th quarter of 24. That increase or those increases in our average selling price really reflect expansion into new markets, which are higher value, higher margin, and a focus on profitability, whereas prior management had really focused more on volumes than profitability. The gross margin expansion has been driven by the higher average selling price, but also a laser focus on cost. We've instituted an every penny counts, every penny is important. Those of you who have heard me speak at the PFAS last year talked about the plant operations people who would pick up a penny, and a few people raised their hand. Who would pick up $1 million? Everybody raised their hand. And what I tried to emphasize to them is that every penny reduction in our operating cost is almost $1 million to our bottom line. So every penny counts. I believe we've had a good job and done a good job of turning around the back business. I believe there's room for further improvement, both in our average selling price, EBITDA generation, and further reducing costs, both operating and SG&A, and we've taken steps to do that in the first quarter. The way I look at the PAC business is, besides the low-cost entry point, I view the EBITDA and the cash flow we'll generate from that business will cover the combined maintenance CapEx of the combined businesses, the combined being the PAC and the GAC businesses going forward. Talk a little bit about the expansion in our granular activated carbon operations. I mentioned that our Red River, Louisiana plant serves as a low-cost entry point into the GAC market. We spent roughly $85 million on the first phase of expansion to be able to produce 25 million pounds of granular activated carbon. We believe that it's the first of 5 potential 25 million pound expansion increments. What do I mean by low-cost entry point? At $85 million for 25 million pounds, we're roughly $3.15 a pound in terms of CapEx for production, whereas we believe a greenfield expansion would be $7 to $8 a pound. We are in the process of finishing and commissioning of the project in production. We have actually produced granular activated carbon, but we haven't produced it on an efficiency and a consistency basis, which I am comfortable saying that we're in full commercial production, and we expect to achieve that by the end of the first quarter, or essentially in the next 11 days. I mentioned our Corbin, Kentucky facility as, producing the feedstock for the Red River, Louisiana production on that. And it's also that what we call ARC wet cake, which is that feedstock, is also a potential feedstock for an alternative product I'll talk about in a couple minutes. A logical question is, if you start commercial production this quarter, when will you be at full run rate capacity of 25 million pounds per annum? We expect that will be in the second half of 2025. And at that point, we also believe we'll be able to determine what is nameplate capacity. We are entirely comfortable at 25 million pounds, but we believe that by further fine-tuning our product, we can expand our nameplate capacity above 25 million to by as much as 10, 20, or even 30% as it relates to that. Our existing contracts, if you will, demonstrate the strong demand. One of the key investment theses for ARC getting into the granular activated carbon, besides having a great foundational asset, was that the market for granular activated carbon is undersupplied with excess demand currently, and that demand is only going to grow. We've got 16 million pounds of our 25 million pounds already contracted. We could contract the remaining 9 million pounds right now. And when I've said that in some investor meetings, they said, why don't you do that? It'd be great optics. And I said, that's all it would be optics. It would not pull forward the cash flows, because the cash flows are dependent on that extra production of meeting full run rate production, but also that I'd like industry diversification. And what I mean by that is that we are in the process of field testing for renewable natural gas. We've passed the first 2 testing phases with flying colors with our potential renewable natural gas customers, but they would like and are demanding in situ commercial size production in the field. We expect the completion of those various tests to be somewhere from 1 to 6 months to completion. That matches nicely with the ramp up to full run rate commercial production. And so more importantly, that's the last remaining step. We've essentially agreed on pricing terms and conditions pending successful completion of those RNG field tests, and that RNG carries a higher price point and higher margin. So when I talk about importance of shareholder alignment, just not optics, this is a prime example of what we're doing. We have the ability to expand our Red River, Louisiana facility up to 125 million pounds to produce granular activated carbon, as I mentioned, in 25 million pound phases. Importantly, phase 2 is already fully permitted as it relates to that, and we would expect to make the financial investment decision as it relates to phase 2 sometime in the second half of 2025. Talking about the granular and pivoting to the granular activated carbon market and market dynamics, as I said, the market dynamics are extremely attractive. The market is undersupplied with excess demand, and that was before the even going through the PFAS regulations as it relates to that and how it goes through. Excuse me a second, I've got to take a sip of water. The PFAS, as I say, the EPA PFAS regulations have gone to reducing the permissible parts per trillion of PFAS in the municipal water supply from 70 parts per trillion to 4 parts per trillion. That essentially equates to 4 grains of sand in an Olympic-sized swimming pool on that. And importantly, our product is extremely important there, in that the current marketplace, we think that the municipal water market is roughly 48% of the granular activated carbon market for potable water. That equates to roughly 170 million pounds of granular activated carbon demand as it relates to that. We think that by meeting in the need to comply with the EPA PFAS regulations, that demand for municipal water alone will need to grow by 3 to 5 times, or 510 to 850 million pounds on top of the existing 170 million pounds on that. I mentioned there are also alternative markets for granular activated carbon. I mentioned renewable natural gas, food and beverage. Both of those and other markets are attractive in the albeit smaller markets, but they carry higher price points and consequently higher margins. I mentioned, again, specialty chemicals, that this is a technical sale, highly technical, and that it serves as a speed bump to entry from new entrants. I also mentioned alternative products in the last couple of minutes I have. One of the things we've engaged in is extensive R&D and discussions with asphalt manufacturers to take that arc wet cake, which we send to Red River, Louisiana for further processing into granular activated carbon, to use as an additive to asphalt emulsion. Our testing and initial testing with the asphalt companies indicates that our arc wet cake creates a harder asphalt, a blacker asphalt, which is important. The aesthetics are important there. A quicker setting asphalt, and more importantly, an asphalt which is less prone to degradation in the freeze-thaw cycle. We are entering into extensive field testing with the asphalt companies this quarter and the second quarter of 2025, which, if successful, will lead to product commercialization in 2026 with very attractive and very comfortable and strong margins as it relates to that.
Hey, Bob.
So,
Bob,
yeah.
maybe I can cut you off there, and we can get into Q&A to get into some more
great.
specifics to leave some time.
Yeah.
So we'll open that up for Q&A. I'll start off. Bob, you're almost 2 years in now. Feels longer because it's your 4th Gabelli conference, including our chemicals conference last year and our 2 PFAS conferences. You've made a lot of progress. You mentioned the improvement in the PAC business and how you view that as covering costs for the GAC business. How do you view that long term in terms of its profitability and its place in ARC?
So clearly it's lower margin. It doesn't have the same growth prospects of the granular activated carbon business. When I mentioned we can produce up to 125 million pounds of granular at Red River, after we produce 37.5 million pounds, we'll start cannibalizing PAC production. And I'm happy to do that because I'd much rather sell a pound of granular activated carbon than powdered activated carbon. So we see still a possibility of improvement in improving the cash flow for that PAC business. And again, it serves as a very important springboard and low-cost entry point into the granular business.
How significantly higher is the margin in GAC versus PAC if you're cannibalizing the PAC business?
The pricing on granular business is a multiple of the pack business. Does it cost more? Yes. But if you look at, when I talk at $75 million or $85 million, it's a 3-year or a little over 3-year payback on the investment. And by payback, I'm measuring EBITDA. That gives you an idea of the margins in the granular activated carbon business.
And then, so you went through, you've completed phase 1 at Red River, which you mentioned, very exciting. You're targeting, you mentioned in the next 11 days, potential for the first commercial production at the end of this month. You were already producing there. Can you take us through what it takes to get there? And do you have any announcements of the first commercial activity?
You know, I couldn't tell people here because I don't want to give anybody MNPI, but in terms of what it is, we're producing granular activated carbon, as I say, it's just not on the consistency and efficiency that we would deem to be full-scale commercial production. It's been, you know, certain things we've had to optimize, sensors in terms of volume where we have some additives to the granular, things like that aren't reading properly, or overspraying or underspraying. It's replacing some screw conveyor belts with regular conveyor belts. It's been, again, basic blocking and tackling. There's been nothing monumental. It's just been a compilation of little things, and we think we're at the half-yard line or the 11-day yard line.
All right. And if there's any questions in the room, feel free to raise your hand, but I'll continue. So the CapEx for phase 1 came in higher than expected. You mentioned your disappointment in that on the call. You mentioned already being qualified for phase 2. And what's the CapEx moving forward? Will it be less than that $85 million? Do you feel like you've got more experience with that first phase under your belt?
Absolutely. We think it'll be $75 million or less. And what's our confidence, and why are we confident? Since we had several price increases in the cost of CapEx for phase 1. It's several. One, we brought the general contracting in-house, so we don't have to pay that. We're now aligned internally, whereas the previous general contractor was cost plus and time and material, so we definitely weren't aligned. We've had certain we've already gone through and done some of the lessons learned where we can reduce certain expenses and certain foundational work, and certain items such as dirt work, etc., which we expensed in or capitalized in phase 1 will inure to the benefit of phase 2. And as I mentioned, it's already permitted, and we would expect once we're at full run rate production, we would make the FID on phase 2.
Okay. And how much, so full run rate production in phase 1 towards the back half of this year, you mentioned 3 to 6 months. What's your confidence in getting up and scaling up with that?
You know, I'm comfortable with that. As I said, we've had some, you know, learning pains and growth pains getting phase 1 into commercial production, and then it's a matter of that continued blocking and tackling. Do I expect issues to arise? Yes, I'd be fooling myself if I didn't, but I think we've got all the major and minor issues out of the way, so it'll be a matter of fine-tuning so that we can be fully automated and start producing at a 6.25 million pounds per quarter run rate.
Then you're going from around 85 million of CapEx this year. You mentioned down to 8 to 12 for 2025 on the call. What's your view on use of cash flow in 2025? Is that just building up for phase 2? And in terms of financing going forward, you did the equity financing last year. How do you view financing the next phases of the project?
Sure. So as I mentioned, I view the PAC business as covering the maintenance CapEx of the combined businesses, meaning the GAC business will produce free cash flow that can either be returned to shareholders or reinvested in the business as phase 2 and future phases. I believe with the cash flow we're generating from the PAC business and the GAC business that we could finance phase 2 and future expansions on a traditional corporate cash flow basis, albeit secured, and that we would not have to sell equity. And also we could add an element of project financing, because I'm comfortable and confident that we could pre-contract portions or all of phase 2 as well.
Okay, great. And are there any questions in the room? Or I'll just ask one last one. So you mentioned tariffs and how you're fully integrated in the U.S. Just wanted to get your conversations with customers and how that's helped as you're contracting in the yak business.
Sure, no, it's helped in the past because, it's been increased cost and product variability in terms of product quality on imported business on that. We've also seen in conversations with customers that with tariffs and others that the pricing for non-U.S. sourced activated carbon has gone up dramatically recently. So again, it's reliability and its product quality and its price, and it also gives us the opportunity to raise our price as well, even though we don't have cost increases.
That's great. And we're coming up on time, so I just wanted to say thank you for joining us again, your 4th time at our Gabelli conferences, and we look forward to seeing you next time, hopefully in person, and we'll see you soon.
Great. Thank you all.
Continued success, Bob.
Appreciate it. Yeah.
And with that, I'll turn it over to Rosemarie to introduce BASF.
It is now my pleasure to introduce Alex Koehler, BASF Investor Relations Officer. Alex joined the company in 2008 and worked in various business development strategy and research. He is now responsible for investor relations in Germany, the US, and Japan. Prior to joining BASF, Alex was at GE Plastics, where he worked as an analytical chemist and product developer. Based in Germany, BASF is a global chemicals company serving many industries such as agriculture, health and nutrition, construction and housing, transportation, consumer goods and electronics, among others. Its strategy is to add value and innovate in order to make its customers more successful. The chemicals segment supplies the other business entities with basic chemicals and intermediates. It is key to the company's efficient value chain. We note that the company is in the process of reorganizing and implementing many changes, which Alex will go over. BASF has approximately 893 million shares outstanding, a stock price of 52.20 euros, market cap of 46.6 billion euros, net debt 16.6 billion, for a total enterprise value of 68.8 billion euros. And I will now let Alex bring us up to date on the ongoing changes at BASF and the company's future within the global markets it serves. Alex?
Yes.
So, don't make mine.
Okay. So good morning, everyone. Rosemarie, thanks for the introduction. Just a slight correction. I've been with BASF all my life, since 2004. So whether that's an advantage or not, I leave up to your judgment. But certainly grown with this company now for more than 20 years, believe it or not. So thanks for having me, Rosemarie, Mr. Gabelli, for a 3rd time in a row, I think. It's an interesting time for BASF, and I tried to convey also to Gabelli that it might be this time around a little bit more interesting to talk about what we actually have done since the last conference. Since we have a newly appointed CEO, essentially 5 members out of the 6 board members in BASF are essentially newly appointed. So there was a lot of change in the 160 years of the history of the company that we now have. And what you see here now on the screen, the winning ways strategy, is essentially the result that came out of a deliberation between the appointment of the new CEO in April last year until September, where we presented this content at the Capital Markets Day. Obviously now in the months between from September to today, I had the chance to resonate or to judge how the market resonated to these changes. And I think I can today give you the laydown of what we expected here. So let's hope I'm not pushing the wrong button. I think that's the right one. So, what's our ambition? Essentially, to be the preferred chemical company to enable our customers' green transformation. I think, especially here on the western side of the Atlantic, there is a lot of rollback of a lot of these kind of ESG initiatives, maybe even more so in the chemical sector. We remain committed and stand firm to the goal that we want our customers to be able to succeed in the green transformation, and I will come later also to some of the aspects that we tie into that. The four categories that you see here on the slide, focus, accelerate, transform, and win, are essentially, or is essentially, the new strategic narrative that we communicate also internally. When I look at the stock performance of BASF over the last 10 years, I actually did a very bad job in investor relations. I think the market acknowledges or gives us the benefit of the doubt that there is much, much more potential within the company than the market capitalization of our company would suggest. And these are actually the pillars then how we would like to set this into motion. So you have the focus. So we would like going forward to more focus on those things that we actually do good, strengthen the strengths, accelerate via internal programs also to accelerate cost-saving measures and the likes, transform in terms of not only the green transformation, but also continuously investing research and development resource in order to come to superior product solution that, following the theme of this conference, are actually allowing us to compete also in specialty niches, where obviously it's much, much easier to defend prices and with that margins. And then ultimately, a winning mentality. So a lot of sports analogies are used within that as well, in terms of, like, in the past, BASF was remunerating its employees on the variable compensation from the board level down to the average Joe like myself on the return on capital employed for the entirety of the company. Now this is changing. Essentially 75% of this compensation package is now linked to the actual EBITDA and cash flow performance of the set businesses where these people are sitting, and only 25% linked to the ROCE of the overall group. So with that, you're actually creating, I assume, a lot of friction as well in the corporate structure, but that is welcome friction, because obviously then everyone focuses on the task at hand, and ultimately that's creating shareholder value. So this slide depicts actually the one largest single change that we now have with this new strategy. Essentially, we are differentiating the portfolio of BASF now into two larger buckets, which are the core businesses and the standalone businesses. When you have followed the narration around BASF before, you might have heard the German proverb of the Verbund, so this kind of synergistic production integration where we are harnessing economies of scale, have a high point of energy efficiency. And this still remains an attribute, but this remains an attribute in particularly for the core businesses on the left-hand side. The standalone businesses on the right-hand side have a limited degree of integration with the rest of the portfolio, and that's why we have charted like guardrails for these businesses, how we would like them to develop further, and I'll go deeper into the details a little bit later. So first, looking at the core businesses, you see the stats down in the bottom left-hand corner, so roughly 40 billion of sales, a bit more than 5 billion of EBITDA. Essentially, just giving you some facts and figures here, what we believe or why we believe these businesses benefit from the level of integration. Just taking one example here, when you look on the right-hand side there, on nutrition and health, there's a vitamins business in there, which is backward integrated in what we refer to as a citral value chain. So it goes all the way up into the petrochemicals division that you see here on the very left-hand side of the slide. And obviously, the scale of production and manufacturing that you have on the petrochemicals step is to such degree as you have this dilutionary effect on the fixed costs that are then relieving some of the pressure on the care chemicals so they can compete better in the marketplaces where they are. And we obviously also have a very high degree of flexibility when it comes to steer product volumes through the different value chains depending and judging where the most, let's say, profitable market sentiment right now sits, and then can deploy these volumes accordingly in order to maximize the contribution margin from these businesses. One major pillar when it comes to the core businesses where we are currently very well invested, you see the picture here on the left-hand side, that's depicting our 7th Verbund site that we are right now building up in Guangdong province in the city of Zhanjiang, right at the coastline of the southern tip of China. Guangdong province has a GDP equivalent roughly the size of South Korea. We're deploying 10 billion euro of capital into that, which is entirely financed from Chinese sources. It's a 20% equity finance out of the cash flows of the operation that we are already running in China, and 80% debt finance via a consortia of banks also in China with very attractive financing conditions. Why are we doing this? Obviously, especially, I mean, I'm talking to US investors predominantly, so I get a lot of pushback on this. Essentially, when you look at the growth of the chemical production market globally and you look at the delta from today until 2030, roughly 3/4 of chemical production will come from China. So in order for us to participate in this kind of growth and also to outperform the global average growth, we need to be in China, and actually there our asset base is not to the same level, let's say, as the domestic sales. And in times where obviously tariff curtains are raised left, right, and center, maybe are also then put down again the day after, we don't know. But certainly a higher level of uncertainty leads us to believe that our strategy to produce domestically in those markets where those products are also consumed is a competitive advantage. And that's why we are going ahead with this investment. The scale up and the ramp up of the heart of the plant, so the 1 million ton steam cracker, is expected to be commenced in October of this year. And with that then also all the adjacent products, because obviously when you start such a big assets, you cannot store the product anywhere, so you need to have your downstream units in line as well. And this year is one of the major years for this investment here. So then the look or the view for this new strategic corridor for core businesses. So you see there on the right-hand side the targeted EBITDA, 7 to 9 billion roughly, so quite a nice CAGR there, obviously influenced by the fact that right now we are at peak capex and peak invest for this Chinese Verbund site, so that will go down significantly going forward, and these additional volumes will also allow us to significantly expand earnings. The assumption here being mid to upcycle conditions. Maybe in the Q&A later we jump also a little bit into the current environment. Certainly we are right now not at mid-cycle conditions, but we believe that this will, or we will move back into that temporarily. So now coming to the standalone businesses. So this is roughly the 21.6 billion that we have here, so roughly cut between core standalone with a broad brush, 2/3, 1/3. These are all businesses which, as I said, have a lower degree of integration with the core businesses. Their value chains are not so much backward integrated into the petrochemical core that we are operating. And if you depict them from the left to the right, and I just move one forward because there you can also see the sales last year, so you get an idea of what kind of business size we're talking. Essentially on the utmost left-hand side, you have the environmental catalyst and metal solutions business, abbreviated as ECMS. So they are headquartered here in just on the other side of the Hudson in Iselin, New Jersey. Some of you might know it as a legacy Engelhard business. So this is essentially the catalytic converter business for in the transportation sector. So we carved out this entity as a fully standalone, still fully consolidated within BASF in the midst of 2023. At that point in time, everyone was asking me, Alex, when will you monetize this asset? It's a sunset business, come on. 2 years later, and everyone is congratulating me that we did not do this, because obviously now with a strong reversal on the BEV front, except China, this business obviously now gets a lot more attention. It's fully invested, high cash accretive to BASF, so we like it very much and we keep it for the time being. Battery Materials, on the other hand, obviously is an antagonist in this play. This business is under, let's say, pressure given the fact that BEV penetration has stalled. We have an installed capacity base for cathode active materials in that business of 190 KT that's spread across all the regions, being China, being also US, Japan, and Europe. So obviously here it's more about de-risking this path. We have stopped our capex into that business. We are now trying to maximize the utilization of the capacities that we already have. But we still see significant differentiation potential on the nickel-based technologies that we are producing and serving here. We are not a player in the lithium iron phosphates, the LFPs, where actually these endeavors in that market started for us. Then third, you have the coatings division. You might have seen recent news flow on BASF. We agreed with Sherwin-Williams to presumably sell our decorative paints business in Brazil to them towards the end of the year, or closing expected towards the end of the year. This was, let's say, the low-hanging fruit because there was very little disentanglement with other businesses. What's still in that division is the automotive OEM and refinish business. So pure play competitors here on US soil are PPG and XETRA, as well as a surface treatment business. Obviously, Quaker Houghton talking later this day is one of our peers in that space. So here we are exploring also strategic options for that business over the course of the year. The talks are just beginning, so very little detail here, but this could also be something that might be better positioned outside of the BASF group, as if it should lead to higher value accretion also for our shareholders. Then last but not least, the big gorilla in the room, agricultural solutions, so just shy of 10 billion in sales. I mean, street opinion on this kind of business from a valuation perspective, we have not officially published anything, but I think 20 billion plus or minus are fair. You'll see us here executing a carve-out or like a legal entity separation for that business, including ERP. Obviously, people were surprised then only by 2027, why are you so slow? But keep in mind that this business has been growing organically within BASF and disentangled with the entirety of the company over 50 years. We have the second most complex SAP system in corporate world just behind Unilever. So this takes time if you want to make it right and simultaneously also guarantee operational continuancy. So their IPO readiness by 2027 is the goal. I mean, here minority IPO is touted. I think there the avenues are still very much open, but this is the current direction of travel that we are aiming for. So also here, what's then the strategic target corridor until 2028? So another 3.5 billion to 4 billion, a little bit of sensitivity in there, of course, which is not so much higher than what we achieved in 24, but also in 23. Why is that? Because obviously Ag Solutions had their record ever year in 2023. Automotive was recuperating and running very well over the years 23, 24. So now it's more like a rollover into 25 on the automotive side. So that gives a little bit of context why that number sits where it sits. So then coming back to the transformation and the green transformation that I mentioned earlier, we still believe that this is very much a focus area and where we are also able to significantly differentiate us from the competition. Already today, we can offer essentially the majority of all our more than 50,000 sales products that we have in our portfolio in a somewhat, let's say, CO2 or more eco-efficient kind of version. Particularly when it comes to the CO2 footprint, we are offering solutions which are then bio-based or which are based on bio feedstocks. So how we do this is essentially via a mass balance approach. So we take a renewable feedstock, for example, displacing naphtha with pyrolysis oil. And if we know that we are feeding 5% of the overall volume into the steam cracker, obviously 5% of the product cut are then also via this mass balance approach guaranteed to have a lower CO2 footprint. And we sell this ultimately to the customer. And this then ends up in a, let's say, more eco-friendly shampoo, for example. For obvious reasons, I'm not an expert on hair shampoo, but I think it's fair to say that at least in Europe, the consumer in general is willing to pay premium prices for these kind of products. Obviously, we are in very, very early stages. I think, especially here in the US, this awareness is of lesser developed degree, but this does not mean that this can also change. And you see the bar on the lower hand side of the slide. So we believe until a certain point in time depicted here between 2030, 2050, these product solutions will become increasingly important. And what we are saying is we are now doing the necessary investments that you see here depicted on the left-hand side, a per annum kind of approximation of the capex that we will need in order to maintain the availability of these kind of products. This capex will make sense because we can earn additional income from it, additional earnings from it, because we can command a premium on these solutions. And also here, the core businesses are uniquely positioned because since we own everything up until the steam cracker, where you feed actually these bio-based solutions, actually the entirety of the value chain sits within BASF. So also there, we are commanding, or we can rule in what kind of value chains we would like to push these kind of products, because for obvious reasons, some markets will certainly be more accustomed to these kind of solutions than others, where you're talking about purely commoditized chemicals. But even though for some of these presumably commoditized chemicals, if you have a butanediol, for example, a BDO, which clearly is a commoditized chemical, I would say, even there, offering such a BDO at a lower CO2 intensity footprint could in future be something that once again creates, let's say, a blue ocean within a red ocean, if that makes any sense. So quickly and just very briefly coming to our CO2 reduction targets. So BASF stays firmly committed to its net zero 2050 ambition for scope 1, 2, and 3.1, also to its 25% goal in 2030, which is in full alignment and agreement with the Paris Climate Accord. So no changes there. And then, since I'm seeing that the clock is running down, shareholder remuneration. I think that's an important topic as well, for obvious reasons. There's also one quite significant change for BASF. In the past, BASF had a very progressive dividend policy, so keeping it stable or increasing it year over year. Last dividend that we posted was €3.40. That was roughly translating to a 3 billion cash out per year. We did this over the last 4 years, so translating to 12 billion of cash outflow from remuneration entirely based on the dividend. That has now been rebased, so we are now proposing to the AGM in May that we will issue a dividend of 2.25, which is essentially 2/3 of this 12 billion that we had. But the 12 billion will remain, so that means that the other third will be contributed by share buybacks that we intend to start in 2027, which gives us a little bit more flexibility on the financing and cash flow projections and how we manage our own financial plan. But the dividend yield still stands higher than 4%, so remains very attractive. And as I said, the whole shareholder remuneration is essentially flat, but you'll see the little letters there. It says at least. So we talked about all these portfolio moves that we are also focusing on. So if they should contribute something that is a bit higher than they expected, then maybe this can also be increased going forward. So here you see the entirety of the business plan until 2028. We discussed all the numbers. You see the downbreak there in core and standalones. Essentially based, and I have to say that assuming these mid to upcycle conditions, we are convinced that we will move from the rather tough conditions that we are still seeing here. And also Q1 25 seems to be a bit of a slower start, especially in the US, considering the freeze that we had alongside the US Gulf Coast. Our cost improvement program will essentially compensate for inflation, and then the real EBITDA lever is predominantly coming from volumes, which obviously are boosted by the investment and the ramp up of the Zhanjiang Verbund site that I mentioned earlier. Here, essentially the similar graph just from a cash flow perspective. So you see free cash flow right now, or in 2024, we had free cash flow at its lowest point. 2025 is going to come out a little bit higher, and from there significantly increasing. Why is that? Because on this slide here, You see the CapEx development. So 2024 was peak CapEx for BASF, deploying those funds into China in order to make that plant happen. And starting in 2026 and the following years, we will move CapEx way below depreciation level, so also freeing up more cash and enabling us to better strike the balance, I would say, on the triangle between the CapEx requirements, the shareholder remuneration, but also, and most importantly, the credit rating that BASF has. I mean, there we are clearly a standout in the chemical sector because we are essentially the only chemical company that still commands a single A rating across all three major rating agencies, and we we aim to keep it that way. We just, I think 1 or 2 weeks ago, Moody's also once again confirmed their rating and also kept their outlook at neutral. So apparently also the rating agencies seem to believe us. So this is just some financials, just quickly going over them. High equity ratio. I mean, financing is broadly spaced and rather attractive. Our pension obligation is more than 90% financed. So also there we have no skeletons in the closet. You see the reduced CapEx here in the middle of the slide, also the optimization of our net working capital. Obviously in 2025 you will see a specific effect since we will ramp up the inventories in Zhanjiang given the ramp up of the production. So there you cannot optimize too much now in 25, but we will continue to do so for the years to come. And then this essentially brings me to the last slide, reason to invest for BASF. I won't read this out loud because you can do that on your own. But I think there are a lot of interesting pieces that we put into place. Now it's about execution. Our management is very clear that they also now need to show that that these changes that they are aiming for are also then ultimately leading to the necessary performance improvements in order to make us a more attractive investment case again. And obviously working in IR, I have to say, an even more attractive case than we already are. And with that, I think I thank you for the attention of following my presentation.
Thank you, Alex, for this very helpful presentation, especially since BASF is going through a major transformation. We don't have a lot of time, but I do have one question, well, actually two. So this major transformation was initiated during a different economic and political environment than the one we have embarked on. Can you talk about how the company is operating in the current environment? And do you think it may trigger some additional adjustments?
Yeah, thanks.
And then the second one, might as well do it
Yeah,
now. Sure. The German administration has recently approved a 500 billion euro stimulus. Can you share how it will potentially affect you and where will you benefit from it?
Yeah, thanks, Rosemarie. I mean, my days right now start very early because the news flow out of the old continent, also from my home country, is rather steep right now. Coming to this 500 billion, certainly that's something that was not baked into our full year assumptions for 2025. So will this provide some degree of tailwind? I would assume so. I think our exposure to those sectors at this 500 billion and also the increased defense spending is peculiar, is I think not that high, but I think it will raise the floor entirely for just like indirect demand that will also then be to the benefit of BASF, so it certainly won't hurt. In terms of near-term trading, I mean, what we have seen, as I already alluded to in the US, especially given the freeze at the US Gulf Coast, that was a slow start to the year. I think when I look at China, we see volume still increasing and performing well, but like pricing power is not there yet. So that gives us an indication that markets there are still long. But since then, obviously also the Chinese administration has put some more stimulus measures into place that should long-term or mid-term rather help. Whereas in Europe, these fiscal stimulus measures, and maybe the German one is not the only one. I mean, France is also mulling some projects there. So right now, it's still trending towards like a lower than historical average kind of level, but we keep it rather positive there on our outlook. I mean, the GDP projection that we have globally is 2.6%. Chemical industrial production around 3% growth in 2025. And I think given the additional stimulus measures, this is not out of reach for us.
Thank you very much. We have stolen about 1 minute from the next presentation, but I want to thank you for coming one more year and look forward to having you next year as well.
Thank you. Thanks.
And now I will leave the floor to Wayne, who will introduce American Vanguard.
Okay, next up we have American Vanguard, ticker AVD. American Vanguard, based in Newport Beach, California, is a specialty chemical and especially an agricultural products company that develops, manufactures, and markets solutions for crop protection and nutrition, turf, and ornamentals management, and commercial and consumer pest control. Its products are sold globally and include insecticides, fungicides, herbicides, as well as formulations for soil health and plant nutrition that come in liquid, powder, and granular forms. The company primarily synthesizes, formulates, and distributes its own proprietary products or custom manufactures, formulates, and distributes for others. American Vanguard has around 29 million shares outstanding, closed yesterday around $5 for 145 million market cap. Net debt of also 145 million for a 290 million enterprise value. Joining us is new CEO Kaye. Dak joined American Vanguard just a few months ago in December, following the board's institution of a new transformation plan and search for a new CEO. Dak has extensive experience in the agriculture industry, joining from Alba, a top 10 global crop protection company, where he last served as president of North America operations. And Dak is also on the executive board of the industry group CropLife America. And with that, I'll welcome up Dak to give us an overview of AVD.
Thank you, Wayne. Thank you, Rosemarie, and thank you for the opportunity to follow BASF in the presentation. Good morning, everyone. I'm Kaye, this new CEO of American Vanguard, the trusted provider of proven agricultural and environmental solutions. Which one? Oh, the green button, sorry. A little housekeeping before we get started. I know most of you know this, but we do have a safe harbor statement where we've got some forward-looking comments in the presentation. This is available on our website as well if you would like to see it in more detail. American Vanguard started its business in 1969 as a manufacturer in Los Angeles, California. Today we have 6 manufacturing facilities across North America producing crop protection products, turf and ornamental, and commercial pest control. The company provides a wide variety of solutions there in those markets that we have here. Sorry, here. My eyesight's failing me. I've known the company for many years, being in the industry. I saw this as a unique and tremendous opportunity to grow shareholder value in the business. It's got a resilient core business that has been stable over the last 4 to 5 years in comparison to the market dynamics that we've had in the agricultural industry. We also have a biological, green solutions portfolio that make up around roughly 10% of our sales today. We see double-digit growth in our biological platform, green solutions, over the next 3 to 4 years. The company has recently gone through a transformation process beginning in 2024, where we have a stated goal of a 15% EBITDA margin. We plan to attain double-digit growth in EBITDA over the next several years as well. If you look at our revenue stream in in the top right box, you can see it's been fairly stable over the last several years in light of the market dynamics. But what's happened is the company's had several self-inflicted missteps that have generated negative impact on EBITDA margins as well as gross profit margins. That is, when I came into the company, I saw that it could easily be fixed with management execution. Looking at our overall sales portfolio, roughly 60% is domestic and 40% is international sales. We're highly invested in the U.S. marketplace. If you look at our domestic footprint, manufacturing footprint, we have 6 manufacturing sites across North America, 5 of them in the U.S., 1 in Mexico. We think we are uniquely positioned to take advantage of potential tariffs into the marketplace. We expect that it'll only have minimal impact on our COGS, roughly $3 million. In previous tariff situations back in the teens, we were able to pass, as an industry, pass along tariff implications onto the customer. So we feel that our domestic footprint will give us a benefit going into these tariffs. If you look at the global industry, the industry itself has been growing over time. It's up to over 60 billion as a market. And we anticipate it growing 2 to 3% a year going forward. Our industry crop protection is made up of herbicides, insecticides, and fungicides. And we do anticipate consistent growth in the biological platform growing faster than the traditional products in the marketplace. Looking at the next slide, you can see that the farmer net income in relation to its expenses, as farmer net income has increased, are going up and down. The bottom line there with the green, where the crop protection inputs, we've seen that stabilize or grow over that period of time. So we feel our portfolio of products and crop protection as an industry is fairly stable and growing in opposite of in contrast sometimes to the up and down to the farm net income. Looking at the green solution space, our biological space, which we have, like I said, 10% of our sales in the biological space, green solutions. This market will be growing. We estimate that it'll double in the next 7 years at 11% CAGR growth, going from 14 up to $30 billion in sales as a market. We are one of the top 10 U.S. biological suppliers, as communicated by CropLife. Looking at our financial performance, we've had a history of not delivering on what we said we were going to do. And one of the reasons I'm here today and commit to delivering on what we said we're going to do. One of the positives that we had coming out of 2024, we did execute on our 24 guidance, which was in the $42 to $50 million range. We did complete that, coming in at $42 million, slightly under on our top line sales of 563, and our EBITDA margin 7.5%. This was down from last year, largely due to oversupply in the marketplace in 2023. We do feel that this will be stabilized in 2025, and as we get forward into the next slide on forward-looking projections. What we've done in Q4 is pretty tremendous, reducing debt $22 million, at the same time reducing $47 million worth of inventory. We did have a large write-off in 2024 in Q4 of $118 million. And some of that was related to goodwill and our SIMPAS technology, which we're no longer focusing on, in addition to some slow-moving inventory write-off. So the $47 million decrease here we're presenting, it does not include any additional write-offs. It is a reduction in inventory through the business. What you'll see is our inventory and our debt runs in parallel. So as we are able to reduce our inventories going forward, we'll be able to reduce our debt going forward as well. So looking at our 2025 targets, EBITDA of 45 to 52 million is our target. Revenue of 565 to 585 million dollars, which will be a nice increase and a positive increase over last year. So goals for 2025. Strengthen the balance sheet is the #1 goal. Coming into the year, we had some really good progress on our inventory. We have a seasonal impact in Q1 where we traditionally see an increase in inventory and increase of debt. So management of net trade working capital is highly important. So the #1 goal for 2025 is strengthen the balance sheet. Reducing the complexity of the company and focusing on our high priority business, our higher priority task, I should say. Executing on the transformation process. Achieving the financial goals that we've provided, and utilizing a resilient revenue that we have, a product portfolio we have to grow additionally, and expansion of EBITDA margin to 15% over time. My mantra has been simplify, prioritize, and deliver. With that, I'll take questions.
Great, thank you, Dak. Thanks for that overview. And we really appreciate you having just joined in December. I know you did a fireside chat about a month ago, but this is one of your first investor events, so we really appreciate you having you here.
Yeah, thank you.
So we'll open it up for Q&A. I'll start off, but if there's any questions from the audience, please feel free to raise your hand and we'll get you a mic. So to start off, the obvious question, you just joined in December. What attracted you most about American Vanguard? You've known the company for a long time, but what attracted you most about coming to this position and this new opportunity?
Yeah, great question. Yes. So I've known American Vanguard for many years as I've been in the industry. It's been a great competitor of mine. It's got a very solid core portfolio of products and resilient to the ups and downs in the marketplace. I felt that it was a tremendous opportunity as I saw that the portfolio was strong, but we had made some self-inflicted missteps in the last several years that created that impact on gross margins and EBITDA margin. So I felt it was a great opportunity to come in as management and have an impact on an organization to create value.
Great. And then now you're just over 90 days in. The board put in the transformation plan before you joined, but you came in, you've seen it in place. How do you view the progress, and maybe what are 3 main areas where you think more needs to be done and progress needs to be made?
Absolutely. The transformation process was initiated by the board. We brought in Kearney to do the evaluation. In my perception coming in, I think there was a lot of low-hanging fruit on one side of the tree that was taken, but it wasn't really looked all around the tree, and there's some low-hanging fruit on the other side. And what I would say there is, from a manufacturing efficiency and production standpoint, there's a lot of benefits that we can gain there. A lot of things from an S&OP process that we can implement into that to increase the overall efficiencies of the plant utilization. The second would be evaluating our R&D expend. It's a substantial amount relative to our business, making sure we're prioritizing what we're spending our money on to get the best value creation out of the R&D to increase our revenue for the long term. And third is going back to my mantra, simplifying and prioritizing and delivering. The third aspect there being that the organization was overly complicated. with processes that I think we can simplify and streamline the business and execute on as a management.
I think we have a question in the back.
What area of the, first of all, good morning.
Charlie.
What area of the crop protection science industry would you like to see the company increase its exposure to? Is it in herbicides or insecticides or fungicides? What area is there that you would like to see a more elevated representation in? And now that you're seeing BASF is going to monetize their business, how does that play out in distinguishing yourself without being a seed player? And there are other companies that don't have seeds, so you don't have to have seeds to succeed. But what areas of science could you pursue that would facilitate an elevation of value that hasn't been pursued because they pursued SIMPAS, they pursued crazy stuff? Now that you're more, you are the crop guy. Mm-hmm. So how do you, where in the crop area would you like to see this? And the second part of the derivative of that is these businesses are scale businesses. They rely on scale. Are there scalable opportunities organically or inorganically that could make sense longer term? Because these industries get their margin from size. What are your thoughts on both of those issues, Dick?
Thank you. Thank you for the question, Charlie. You know, historically, American Vanguard has been a company that has bought products from the larger companies like BASF that have gone through a rationalization process and been able to extend out the life of those products in the cash cow, generate cash for a much longer time period than they would have inside of a larger organization. So the focus has been there on that from a historical standpoint. From a portfolio standpoint, we are largely, or not largely, our largest section of products is around insecticides. So and then herbicides, and the last one would be fungicides. As we grow our business, you know, to get more sustainability in that crop business, you know, focusing more on the herbicide and fungicides would be of benefit to stabilize, to grow more in conjunction with the marketplace. Having said that, we do have significant AIs, active ingredients or products in insecticides that I think we can leverage going forward. I think the opportunity for growth where we can fit, where we have value, is as our strong portfolio of biologicals and our research in around biologicals as well, and how we can bring those together with synthetics to mitigate the exposure on the crop acre that's being demanded today by the consumer. The lower amount of synthetic chemicals on the acre is an opportunity there to combine mixtures. I think mixtures in general, new mixtures as an opportunity for us as well. We have a very developed R&D laboratory and formulation process to develop new mixtures to bring to the marketplace with our existing active ingredients. As far as utilization, I guess, or economies of a scale, I think that was the question, the second question around that. I think as you look at our manufacturing footprint, we are largely synthesis capability. It is underutilized today. That's clear. To run a synthesis plant, you need to be 90% capacity utilization. We're much lower than that. That's the reason I mentioned that one of the opportunities for us as American Vanguard is to increase our throughput into those manufacturing efficiencies and manufacturing plants. I think that is a real opportunity, and that's where we get the economies of scale on our current footprint. There could be some rationalization there as well that we're looking at as well to maximize our capacity utilization.
Got a couple more questions in the back.
Yep.
Thank you. Maybe not today's problem, but with chemicals being a major cost input for the farmer and the machinery manufacturers with precision ag looking to maybe reduce the consumption of herbicides, fungicides, pesticides by 60 to 70% with next generation technology. How much of this are you as a management thinking about relative to maybe this being a 5, 10, 15-year secular headwind for the industry?
Yes, we're adapting. For one, our portfolio products are largely pre or early post. In that situation, they're not as subjected to that see and spray technology. That's one thing that but we have to continue to look at it. I mean, I've been in the industry quite a long time, and 10, 15 years ago, the big discussion was around the impact on biologicals on our industry. We've adapted to that, and as you can see, American Vanguard has a good solution for that going forward. The technology around see and spray is something we have to continue to watch. I think it's still out there. I actually had the opportunity to visit John Deere's see and spray technology because it's based in Ames. I was more nervous before I went to that testing than after that testing. I will say that. I mean, they're only anticipating 10% of their equipment, new equipment sales to be see and spray technology by 2030. But it's something that we watch and we acknowledge and we work for. I think some of the formulations that we can create, higher concentration formulations, will benefit that technology as well.
Dak, given your embedded knowledge, can you give us a quick 101 on the size of the herbicides, insecticides, fungicides? What's the addressable market in the United States for 1 year and then the rest of the world? And where are your products sold right now? And which of these categories and which of the markets? And then, obviously, we'll talk about the Department of Agriculture.
Okay.
Yeah, I know.
A lot of questions.
Good luck on the last one.
Yeah. Yeah, so the total market globally is over $60 billion. In the U.S., it's fluctuated over the last couple of years to the commodity prices and the supply and demand of 21, 22, 23. So we've seen fluctuation there. But the consumer or the farm gate pricing, as we like to talk about, it's around $16 billion in the U.S. At that level. Where we play, it's a lower level. There's some distribution in there as well. It's predominantly the larger portion of the market is herbicides, then fungicides and insecticides. So that's kind of plays out. Our products today are sold, like I said, 55 to 60% in the U.S. And then internationally, the other 40. We're stronger in the U.S. It's both non-crop and crop there, differential between the two. And internationally, and we are a supplier of product to the distribution channel in the U.S. So we sell to the main customers, the main 6 customers in the U.S. and ag market. In our international market, it's more broadly spread out. I would say, it's concentrated more in Central America, where we have a strong distribution footprint where we distribute our own products as well as third-party products. We've done a really nice job in that marketplace in Central America with the green solution portfolio, the biological portfolio, not only distributing our products down there, those biologicals, but also third-party products, Japanese technology as well, from Certus and Valent, for example. So we've got a good footprint in Central America. Brazil, a reorganized Brazil. We reorganized Brazil first part of this year to focus on our own portfolio. That market is the largest market in the world. It's highly competitive, and we were distributing products in Brazil like we are in Central America, and that market's just not able to handle an extra mouth to feed in the channel. So we're focusing on our own portfolio in Brazil today.
Great. So you touched on some of the changes. We had the big write-downs in Q4. Adjusted EBITDA margin came in, though you mentioned before, at 7.5% for the year. And there's a goal, was mentioned before you joined and reiterated by you, to double that over the full cycle. Just with the actions that are taking, can you describe the bridge to that 15% EBITDA margin, and how soon do you think it's plausible?
Sure. It is the goal. It's a stated goal of the company from the board standpoint, and it's a stated goal from the management as well. You know, when I look at it, you show the chart, the change in margin, gross profit margin from where it was previously to where it is now, and OpEx where it was and where it is. I think there's opportunity. So, to answer your question, you know, we're at 29% gross profit margin today. I think we need to be upwards to 32, 33, and then so that's one component of it. On the other side of it, OpEx is relatively high, in my opinion, compared to our competitors at 26%. We should be more down towards 20. So the combination of those two components will drive that EBITDA margin percentage closer to 15 or at 15 over the full cycle. It's a goal. It's a stated goal. When we will get there, we feel it will get there in the foreseeable future. I put a number on. There's a lot of things. I'm new to the company. I think there's a lot of levers to be pulled to get us there faster, quicker. Then we'll have to do some fine tuning on the long term.
Great. And then Charlie mentioned, and you mentioned with those write-downs in the quarter. One big one was SIMPAS and the decision to, you know, de-emphasize SIMPAS and not continue to invest in that project. How much cash does that free up for the core business, and what are you looking to do with those assets?
Good question. I mean, SIMPAS was a focus of the company for the last few years. It's a business that I don't think we should have been in. I don't think the board today thinks we should not have been in. So that's the reason we're exiting, or deprioritizing, I should say, or exiting that business. The board executed on that in 2024, so that the cost or the cash flow allocated to SIMPAS in 2024 was reduced quite a bit. So if we're looking at 24 versus 25, we're probably talking $1 million or $2 million savings there. That already been SIMPAS in good years or in bad years, let's say, was a $9 million cash outlay. It should have probably in the $5 to $6 million on a normal year. They reduced it in 2024. We're going to reduce it some more in 2025. We're down to almost essentially just maintenance of ongoing customers, which is fairly minimal. We are going to find a home for it. It's not valuable to us as a business or as a technology, but I'm sure it's valuable to somebody out there.
Okay, great. Well, with that, we are bumping up on time, but I really appreciate you joining for one of your first investor events with us, and AVD is my best idea for 2025, so I'm wishing you all the success.
Thank you. Thank you, Wayne. Thank you.
It is now my pleasure to introduce the next company. I am delighted to be joined by Jeff Schnell, who is Vice President of Investor Relations at Quaker Houghton. Jeff joined the company in 2022 following IR positions with several other companies. He started his career as an equity research analyst at Jefferies. Quaker Houghton is a global leader in industrial process fluids. It serves industries such as steel, aluminum, automotive, mining, aerospace, and metalworking, to name a few. With Quaker Chemicals' acquisition of Houghton in 2019, the company doubled its size. The combined entities are operating within a 13 billion addressable market, to which they offer products such as continuous casting fluids, hydraulic fluids and greases, as well as other critical oils used by metal working shops. Quaker Houghton has 17.8 million shares outstanding, a stock price of about $130, market cap 2.3 billion, net debt of 518 million for an enterprise value of 2.8 billion. I will now let Jeff bring us up to date on the company's operations and talk about the recent change in management with the nomination of Joe Berquist as its new CEO. Jeff? Oops. Yeah, whatever you prefer. This is probably easier. And the green goes forward.
Thanks for having me here. I appreciate seeing everybody in the crowd here. I'll go pretty quickly through some slides, of course, the non-GAAP disclosures, but looking here, Quaker Houghton's the global leader in industrial process fluids. We're a specialty chemical company with a service tilt, with approximately $1.84 billion in revenues, as Rosemarie said, an asset-light model, and a strong free cash flow generation capabilities. We also have a proven flywheel of investing back in the business and high returns from these organic and inorganic growth investments. You know, looking here, we're organized into 3 segments. The Americas, as you can see, is the largest, approximately half our sales, with EMEA and APAC representing the rest. China is a large portion of the APAC business, but it's also very important markets like India, Southeast Asia, and elsewhere. If you look at our industry categories on the left-hand side, we serve the metals industry. So simply put, when metal comes out of a furnace, it needs to get formed. That's where we get involved. When it gets into its original form, we call that metals, and there's a whole host of processing fluids that are needed to get it into its initial shape. You have rolling oils, corrosion preventatives, acid inhibitors, so we call that the metals side, which is about 1/3 of the business. When that sheet then needs to get stamped, formed, forged, or whatever to make a hood of a car or a tractor or a refrigerator, etc., we have a whole host of forming fluids, metal removal solutions, you name it. We call that metal working. So you got the metals, then downstream, sort of, if you want to think of it that way, into metalworking. As part of metalworking, we also have a host of operating solutions. So these are process fluids that are treating the machines that are processing the metal. So think fire-resistant hydraulic fluids, for instance. So things to increase tool life and help create value for customers that way. And then lastly, we have a whole bunch of advanced solutions that provide some sort of added benefit, perhaps even in the finished product. So you can think of things like performance coatings or surface treatments, or even die casting and impregnation parts, which we've gotten into since 2019. So that's how the business is arranged. But you know, we have 3 main segments and 2 industry categories. This slide's very vital to us. It's pretty simple, but we pride ourselves on being the best technical expertise in the industry and having a very wide portfolio of products and services. But our biggest differentiation is our customer intimate service model. Our offerings are tailored to customers' needs. These solutions we provide are working on living organisms, if you think of it that way, in a steel mill or an auto OEM or aerospace. They constantly need to be changed so that the specs are operating in the right way so that we can increase the performance of our customers' facilities. In general, our products help to improve labor costs, improve the productivity of our customers, reduce their waste, help them to reach their sustainability goals. There's a tremendous amount of value. So we're rarely the cheaper solution on the market, but we certainly sell on a total cost of ownership model and improve customers' performance that way. In its most intimate model, we have what we call fluid care, which is essentially, if you think of it at an auto OEM, we may have a team of individuals on site every day providing service to our customers. They wear the customer badge, but there really are folks. Maybe 20 years ago there was big engineering departments for a lot of these facilities, but in its current state, we are that engineering arm, we are that R&D, and we are that technical expertise that's there for the customer. The next two slides really just have the range of portfolio we have, but I'll slip here to slide 8. And as I mentioned, we're the only pure play in the industry with a large and growing TAM. Our industry is extremely fragmented. Our market share, we estimate, is in the low teens, higher in metals, lower in metalworking, and advanced in operating solutions. We compete with a handful of multinationals, as you can see, but there's also a large part of the market that are sort of mom and pops, small one technology, one product line that provides a great technology or service to a customer, but doesn't have the ability to scale or have other technologies they can provide to get the full suite of products for a customer. We also have approximately 3% of our sales in R&D, which, if you think about these smaller players, that could be more than they earn in sales in a year. So we certainly pride ourselves on investing heavily in the technology of the industry. If I switch here to our end market mix, as Rosemarie said in the beginning, we have steel, auto, aluminum, aerospace, general industrial, containers. Generally speaking, industrial end markets. This diversification certainly happened with the combination in 2019 of Quaker and Houghton, whereby Quaker was more levered to steel and auto, and Houghton was more levered to aluminum and general industrial. You bring the two together, a very diverse end market mix, very balanced. And the beauty of this is that in times where one side has been down, we've seen acceleration in others, so it's very balanced in terms of our overall portfolio. And then maybe I'll skip ahead here through our presentation and get to, how do I go back? Maybe this one. So I just want to touch on our path forward and our growth algorithm, which I think is hugely important if you think about Quaker Houghton. We operate in markets with underlying demand that is growing. Our TAM is growing. We're getting into new products and services and constantly looking for white space. We believe our end markets tend to grow approximately 1% to 3% per year over time, and that's despite the environment that we've operated in the last few years. We think nothing structurally has changed in these end markets. Our aim is to grow 2% to 4% above that underlying market trend. We do this through share gains and through share of wallet. If we're in a customer today and we add in another product line or two, there's very low incremental cost to serve, so it's a very high value model. And there's a lot of leverage in our portfolio to unlock this growth and return back to the algorithm that we've had. We have a healthy margin profile, and we generate a lot of earnings and free cash flow, which we use to execute on our disciplined capital allocation program, which is to pay dividends, to invest in our organic growth, to invest in bolt-on M&A strategy, and to remunerate shareholders and maintain the balance sheet flexibility. So with that, Rosemarie, I'm happy to walk through your questions, and shall I sit with you? Or?
Yes, sure. We need,
I don't know. Here we go.
Well, thank you, Jeff, for this overview. Well, I realize it is still early. Joe Berquist, who had been EVP and Chief Commercial Officer since 1997, was named CEO this past November. Can you share some of the changes, if any, that the company has begun implementing? And I should point out that this is a second CEO in a very short time, since the first one retired a couple of years ago.
Yeah, it's a good question. Mike Berry was our chairman and CEO from 2008 till 2018. Then we had a CEO, Andy Tomatich, who came in, Mike Berry was till 2021, and Andy Tomatich came in 2021, was here for 3 years. You know, Joe has 3 main priorities here. Number 1 is to return to growth. Number 2 is to reduce complexity in the organization. And number 3 is to execute on our capital allocation strategy. We have certainly been implementing some of these changes. He's got a lot of experience in our business. He's been here approximately 28 years. He's run commercial, he's run strategy, he's run different regions for us. So he's a lot of experience with our products and our service model, and in our business, really understanding the customer's needs is incredibly important because of how intimate our service model is. I would say the growth and complexity piece are fairly intertwined. We're working to globalize Quaker Houghton, so we're building a new facility in China to support the needs over in the Chinese market, which is a growing market, but also a very important market from the global metals production perspective. We're being targeted with other investments, namely trying to be more responsive to customer needs. Over the past few years, we've really focused internally, building some of the functional critical capabilities that we've needed. If you think two companies came together and this, you know, we generated the cost synergies, but we really wanted to stand up the organization for growth while doing so in a difficult market. So the priorities for Joe are really refocusing on the customer, making it easier for customers to do business with us, simplifying the organization, and delivering, of course, delivering growth and good results that we can invest back into the business.
Thanks. So after declining 230 basis points in 2022 to 13.3%, EBITDA margin has more than recovered, reaching 16.6% in 2024, despite an almost 6% decline in revenues. Can you address the changes which contributed to this result, and can you share the company's long-term margin target?
Yeah, we've executed pretty well through this difficult market environment. Our industries have been down, but you know, again, our algorithm to grow 2 to 4% above the market has been there. We've certainly been taking share with new and existing customers from a wallet share perspective. When the inflationary period happened, the philosophy was to price to gross profit dollars. Margin, you know, inflation had continued, so we got more aggressive with pricing. And we recovered our margin profile from a gross margin perspective to the mid-30s, and EBITDA into the mid to high teens. Our margin expectations are to grow gross EBITDA dollars, but also to grow margin, maintain it consistently in the high teens, and push towards 20% over time.
And can you give us an overview of the aluminum and steel industries in which you operate, what the company sees in terms of the impact from the announced tariffs, and what the impact could be both directly and indirectly?
Yeah, tariffs are interesting from a direct perspective. We have facilities globally. We operate a local for local market in pretty much every region we operate. So from a direct impact, fairly limited. We have the ability, and we've put in mitigation plans in place prior when there have been tariffs on the industries we serve. We have facilities in Canada, Mexico, and China, across Europe and throughout. So we think the direct impact could be fairly limited. The indirect impact is harder to ascertain, of course, depending on how the tariffs play out and how they affect our customers. Certainly, we supply the metals market, the auto markets, so depending on what ends up happening, we'll have to assess. But, you know, again, we have the ability to serve our customers in whatever region they're operating in, and if that means maybe demand comes out of one area and goes into the other, we have fairly equal share across the globe. So we think we pretty much have the ability to serve our customers. But the impact, of course, on global growth is one that we have to watch, and we'll see how that plays out.
Are you hearing any tidbits, for lack of a better formula, on my side, but anything from your customers? What are they saying? Are they postponing buying? Are they buying ahead? What do you see?
Yeah, hard to answer. I think the uncertainty is certainly there, but you know, we have a fairly just-in-time business, so we're helping to support the demand as we see it.
So when you reported the fourth quarter results, you mentioned strong aerospace and primary metals. So how large are these two categories, and what do you see developing in 2025? Do you see that same growth continuing, or the current environment means that they are going to slow down?
Metals has been, so metals, as you saw on the prior slide, was about a third of our business. Aerospace, 5 or less. Both those markets have been dealing with their own challenges. You had some labor challenges in the aerospace market last year. You also had on the metals side, you have European metals demand or supply has been impacted by energy. We tend to be a very small part of the overall cost of goods sold for our customers, a very high value add. So in this more challenging market, we've been gaining a lot of share in the metals market. Very pleased with the in all regions how the business is performing from that perspective. Aerospace, certainly we believe in the long-term trend. We have a lot of very cool technologies that are there to help with the production process. So both these markets we expect we're going to continue to grow and continue to take share.
Any questions from the audience? Yes, there is one to the right. Wait. Yeah.
Thanks, Jeff. Thanks, Rosemarie. Your balance sheet is fairly healthy, and you put up the slide that talked about market share, and it looked like obviously 50% of the market is dominated by moms and pops. Can you talk about your growth strategy and the M&A environment in terms of being able to grow through acquisition versus growing organically, maybe somehow challenging that very large market share that the moms and pops have?
Yeah, absolutely. It's a great question. Balance sheet right now, net leverage about 1.7 times. When we did the combination with Houghton, we levered up to approximately 4 times, and we've been delevering ever since. During that period of time, we've also maintained our penchant for M&A, so we've done a handful of deals over that period of time. Even over the last 18 months, we've done 3 deals. These are small, so last year, somewhere in the range of $40 to $50 million of cash spent on M&A. Through COVID and whatnot, I think the market itself was, it was hard to really gauge what normalized earnings power for some of these organizations are, what the power is, how the market was going to be evolving. Plus, we were delevering. So we, in our portfolio, in our pipeline, we certainly have a range of sizes and scopes of deals, both in traditional metals, but also across metalworking, advanced and operating solutions, which we're going to continue to execute on. Timing, as you know, is very lumpy when it comes to M&A. It has to be the right time, but this is a very valuable tool that we believe in shareholder value creation. As I mentioned, the market grows, somewhere in the 1% to 3%. We aim to grow 2% to 4% above that, and then use M&A as an accelerant to our growth, whether it's a new technology, customer, channel to market, and then we have the ability to leverage it across our entire portfolio, which is a unique characteristic of what we have relative to the other side of the market.
Following up on Keith's questions, you have, as you mentioned, made 2 small acquisitions in 2024. One, I really insist in calling it 25. One in South Africa and one in Japan. We also made another one since year-end, so spending about $55 million for all 3 of them. Can you share the rationale behind the transactions, and how much do you think they will contribute to 2025 results?
Yeah. We did IKV, which is a specialty grease player in Europe last year, as well as Sutai, which is for die casting and impregnation of parts in Japan, and the small one we just did in South Africa. By and large, very complementary to our portfolio. If we think about both of them in the same light, this is giving us the opportunity to have great technology in IKV's sense in Europe, which is going to help us with the grease market. We don't like to ship our products, across oceans. It's there's these liquids, high water content in some cases. So you want to make sure you have local capacity, and you want to make sure you have the mix of products everywhere. But in both those instances, we have the ability really to scale and cross-sell the capabilities of their portfolio with our technical expertise everywhere. That's been the playbook now for as long as I've followed the company. It's worked really well. There's still opportunities from the combination from cross-selling. These provide more opportunities because when we go to a customer, we want to make sure we have the whole range of portfolio to serve their needs because, again, the incremental cost to serve once you're in is fairly low. But the technical aspect is important, so we have to make sure we also get our technical experts everywhere and we get all the information sharing, the R&D channels working appropriately. So that's what we're focusing on. And back to your first question about what Joe's doing, Joe is really making sure that there's a streamlined communication network throughout our business and make sure we get those technical experts to help go sell.
And so just finishing up on that topic, how much leverage would you be willing to take for large acquisitions? And first of all, is there such a thing that you might be interested in?
The combination with Houghton took a long time to consummate. It was years in the making, from what I understand. It predates me. We levered up to approximately 4 times during that combination. A lot of synergies in the deal. A lot of balance from a end market perspective, a lot of great technologies that both companies share. So that, you know, from a recent perspective, I suppose that's where we have done. We generate a lot of free cash flow, so we have the ability to delever pretty quickly. We've stated publicly that we'd like to operate in 2.5 times and lower. Currently, we're 1.7. And again, the pipeline has got a range of sizes and scales of deals, and we're going to continue to execute on throughout the sizes.
So approximately 48% of the company's revenues are generated in the Americas, 29% in EMEA, and 13% in Asia Pacific. EMEA has by far the lowest operating margin. Is there any possibility that you can bring that margin to the North America's level, or are there specific conditions in EMEA that would prevent you to do that?
Certainly the EMEA market is the most fragmented of the markets. You know, there's country by country, there's rules and regulations throughout each, so it's definitely a highly competitive and fragmented market to operate in. With a lot of ongoing challenges right now. For instance, we exited Russia when that happened. We had some tolling business as part of the combination too. So we completed a cost program, a $20 million cost program last year. Some of that targeted Europe. We announced another $20 million of cost actions we're taking for this year, 15 of which will be in year. Some of that will certainly target the EMEA market. I think, generally speaking, there's absolutely opportunity from an EMEA margin perspective. Some of this will come with further network optimization and procurement actions, and then, you know, we have to wait and see how our customers are thinking about the EMEA market long term. Which we certainly see as, you know, will be an important market, and we want to be able to serve our customers, and but we'll adjust our size accordingly if and when those decisions get made.
Do you see, in terms of EMEA, do you see any pickup in the demand level, or are they still kind of sticking around the bottom of the economic environment?
Yeah, we certainly think they're more at trough levels than anything else. I will say, though, our team has done a phenomenal job in Europe, gaining share with customers in metals and metalworking, really with this value proposition of, hey, I understand it may not be the lowest cost, but lowest price, but it's certainly the lowest cost. We help them achieve sustainability goals. We help them achieve productivity and energy savings and labor costs. So our value proposition is alive and well in Europe, even in this very challenging market.
Thanks. Can you, excuse me, can you share the percentage of your operation serving the automotive industry? It looks as if the tariffs in Canada and Mexico will affect production. What can you do to offset that impact And how large could that impact be?
Yes, total auto transportation, we say, is approximately a quarter of the business, as you saw on the end market slide before. And as I mentioned, we have plants in Canada, we have a plant in Mexico, and throughout the world. So we have the ability to be nimble based on where the production is occurring. But as I mentioned before, the difficulty will be to understand what tariffs could do to total underlying demand. But we're watching carefully, and we're, again, trying to gain share with customers, help them improve their operations, and we think that value proposition still works well, and even in this environment.
So is the production in both of those countries mostly for domestic consumption, or is some of it coming back to the U.S. and therefore may affect your results?
Both.
Okay. And I was wondering if you have seen any change in the demand level for your products since the end of the fourth quarter.
Seasonally, our business tends to see an improvement in North America, or the Americas in general, and EMEA markets in the first quarter. APEC contends with the Lunar New Year. So that's kind of the rub you see in Q1 relative to Q4. And I think by and large, that's what we see playing out. That's what on our call we mentioned we would expect.
What kind of visibility have you had historically, and is it at the same level currently, or given the environment, the visibility suddenly has declined substantially?
I think the visibility, there's just more uncertainty in the markets today than there have been in the past, as customers and companies try to evaluate the impact on some of the tariffs and whatnot. But generally speaking, we have pretty good near-term visibility, and we're so intimate with our customers that we tend to understand what's going on in their planning horizon.
By near term, what do you mean? Do you see
1 to 2
2
quarters.
weeks out? How many?
1 to 2 quarters.
That much. Okay. Any questions from the audience? Yes, Charlie.
Jeff, is your business capable of, to some degree, being price correlated to some of the metal markets for pricing? Like, we're seeing something going on in the gold market that's unprecedented since the 70s. I'm wondering if that migrates to other metal markets and to metal process chemicals like your own business, where there could be a story to your business having more financial flexibility to process industries associated with those metal industries, like metalworking that you're talking about? Or am I just hunting down the wrong path? I'm just wondering what you're thinking.
Generally speaking, we're fairly agnostic to what the price of the product our customer is producing is. We're production based, right? How many units, and therefore how much product is correlated more to that. But to the indirect angle of how much, what the customer's pricing model is and how that impacts their demand or their production levels, that could have an impact there.
Okay, because I was just thinking maybe the gold market's saying something about the world. And maybe that translates to other metal sectors or inflation hedge sectors, and your industry is basically one that facilitates the efficiency of those metal producing markets. That's why I was just, okay, thanks, Jeff.
Are you?
Jeff, as you're looking at transactions, you've been there since 2022, but you're in the business forever as a sell-side analyst. Do you sit down and say, hey, deals are going to be easier in the next 2 or 3 years to close if we make an announcement of something that's a little more of concern because of regulation changes in Europe and what's that other country? Oh, the U.S.
It certainly feels that there's more chatter about M&A in the chemicals sector than in prior years. That's more of a general comment, right? I mean, our pipeline has been pretty healthy now for a number of years, but Oftentimes, the companies we're buying on the smaller end are family-run that need succession. They look to Quaker Houghton as a company that continues their legacy, helps build and grow their business and scale it, which they couldn't do. So we're going to continue to execute on them, but they're, those are, timing is really uncertain. But certainly, I think, from a market perspective, it feels a healthier market than in prior times.
Thank you, Jeff. We appreciate your participation and look forward to following the progress for Quaker Houghton.
It looks like there might be one more if I have.
Is there another question?
Yeah, it's just a quick question. You mentioned that you're bringing your engineering team into the plant, and you basically serve like the expert engineers on some of the machinery that's used there, which is a fantastic niche. I'm wondering, do you charge explicitly for labor time of your people if you're not selling any of your products in, or is it only just, feel-good customer consulting around selling actual products and fluids and everything like that?
No, there are different models, of course, for charging for it, whether it's through product sales or through explicitly through the labor. But it depends on the customer contract, depends on the negotiation with them. But less the feel good. It's more about how do we create the value for them long term, and then share in that value over time.
Well, could it be a profit center on its own? I guess it's my driving force.
I think you could look at, we have a product called Fluid Intelligence, which essentially is using digital tools to help do a lot of the samples and whatnot that our people do every day. I think, depending on how that model shakes out, especially for the large tail of customers, you could look at it differently. But for us, it's more about how do you use the service model to gain more wallet share with customers over time.
So now I have stolen 2 minutes from the next presenter.
Thanks, everybody.
Thank you so much. So it is now my pleasure to introduce the management of Minerals Technologies. We are fortunate to have Erik Aldag, the company's Chief Financial Officer since 2022. Erik joined the company in 2017 as Director of Financial Planning and Analysis. Prior to joining MTI, he held several managing and financial positions at Arconic, formerly Alcoa. Also with us is Lydia Kopylova, Vice President of Investor Relations. Lydia joined the company in 2021 as Vice President of Corporate Development. Prior to joining, she was with McKinsey. So Minerals Technologies is a resource and technology company focusing on minerals-based products and systems. Since its acquisition of Amcol in 2014, the company serves multiple less cyclical end markets compared with its previous main exposure to mostly paper and steel. With a focus on consumer-oriented product lines and end markets, in 2023, MTI reorganized its operating segments to better reflect management's internal focus, and we can already see the positive results. MTX has 31.9 million shares outstanding, a stock price of $68, market cap of $2.2 billion, net debt of $634 million, for an enterprise value of $2.8 billion. I will now let Erik bring us up to date on the company's operations and talk about the benefits resulting from its new organization, entry into new markets, as well as the outlook for the future. Erik?
Okay, thanks, Rosemarie. Appreciate that introduction. Good morning, everybody. Thanks for your interest in MTX. I have a few slides to get through here, and then we'll have some time for questions. So if you could just flip to the next slide, please. Or I'm controlling it?
Yes, you do.
Sorry.
The green box.
Okay, that's easier. So this is just boilerplate language. I'll be mentioning some forward-looking statements, and we're using some non-GAAP measures here, so just take note of these cautionary remarks. So why Minerals Technologies? This is essentially our investment thesis for you all, where we've got leading market positions across all of our 4 product lines, and I'll describe those in a few minutes here. We've got a balanced portfolio of consumer and industrial businesses, and as Rosemarie alluded to, this portfolio has really evolved over the last 10 years and and accelerated over the last 5 years from one that has been more industrial and cyclical to one that is more balanced with more of a consumer-oriented side. And the reason that's important is that it helps balance out and stabilize the long-term growth profile of the company. And we think that that is still an underappreciated aspect of the company, its ability to generate long-term growth through the cycle by virtue of the fact that the portfolio has evolved over time. We have multiple levers for organic growth and inorganic growth, and I'll touch on those. We've got a really attractive financial profile. The company has always been a strong cash flow generator, and importantly, while setting the company up for higher levels of growth, we have not sacrificed the cash flow generation profile of the company. So the company remains a very strong cash flow generator. That provides a lot of optionality for us in terms of shareholder returns and also growth going forward. And we've got an experienced leadership team with a lot of industry experience. Okay, so just high level here, we're a global specialty minerals company, $2.1 billion in revenue, 4,000 employees. We operate around the world in 34 countries, and we're technology focused. We've got 12 R&D centers around the world. Our products are an essential part of your lives, probably more than you realize. We're generating products that we're either putting them on the shelf and you're using them in your day-to-day lives, everything from personal care products to cat litter, or our products are going into our customers' products as additives, and you're coming across them in your daily lives. We've got a global footprint aligned with our customers and our growth opportunities, and importantly, we're vertically integrated from the mine to the market. So that provides a competitive advantage for us and insulates us from a lot of the challenges around inflation and tariffs that we're hearing about specifically. In terms of the regional mix, we're a little over 50% North America. Most of that is the US, 25% EMEA, a little less than 20% Asia, and a small percentage from Latin America. So we report in two segments. As Rosemarie mentioned, we resegmented the company in 2023 from more of a legacy mix of businesses that were really a function of what we had acquired over time to this is a better reflection of what the company is. It's a balanced portfolio. There's a more consumer-oriented side. We call that segment Consumer and Specialties. And there's a more industrial side. We call that segment Engineered Solutions. And we report in 4 major product lines. You can see listed here on the screen. I'll start on the Consumer and Specialties side of the house. In general, these are more consumer-oriented products. As I mentioned, these are either ending up on the shelf or our products are going into our customers' products that are ending up on the shelf. Starting with the household and personal care product line, this is our most consumer-oriented product. This is our mineral to market or even mineral to shelf product line. These are things like cat litter, personal care, so skin creams, retinol delivery devices, also natural oil purification, so edible oil purification, but also increasingly renewable fuel purification is part of this product line, and then animal health and agriculture applications as well. The specialty additives product line, these are more mineral additives, and they go into end markets ranging from food and pharma, residential construction, and also paper and packaging. Over on the engineered solutions side of the house, this segment is less about products and more about helping our customers with their processes and delivery of their projects. So we have 2 product lines here. One is high temperature technologies. So this product line is serving the steel and the foundry industries. We're basically delivering engineered blends to the foundry industry to help them make their molds that they're making the cast products from. And for the steel industry, we're helping them maintain and extend the life of their furnaces by not only delivering the product, which gets gunned onto the interior of the furnace walls, but also the application equipment. And this has also been a growth area for us. We have automated laser measurement and application equipment that we've been selling to steel customers to help them make their shop floor safer and their processes more efficient with this automated equipment. And then finally, the environmental and infrastructure line. It is what it sounds like. It's mostly project-based, serving needs around environmental remediation and infrastructure and building materials type of projects. So we've got leading market positions across our product lines. So where does this come from? This slide is a little bit about what makes us unique and what gives us our competitive advantage. And some of these are hard to read, but I'll just summarize at a high level. It's not only the differentiated reserves that we have, and the minerals that we mine are primarily bentonite and calcium carbonate. We have deep, long-lived, and unique reserves in terms of not all bentonite is created equally around the world and not all calcium carbonate. So we have unique mineral reserves. But on top of that, we have these 4 core technologies we have listed on the screen and a deep application expertise so that we can help our customers make their products better and make their processes more efficient. And so it's the combination of those 2 things combined with our deep understanding of what our customers' needs are, the global reach of our mineral reserves, and our innovation focus that results in these #1 positions that you see on the right-hand side, and I won't go through all of them. We've got multiple levers for organic growth. So we held an investor day in 2023 where we came out with long-term 5-year growth targets and income targets, and we laid out the view there that the company is capable of mid-single-digit growth through the cycle. And that still holds. So through the cycle, this portfolio should be growing at 4 to 7%. And that's from the expansion in the higher growth consumer-oriented markets that I've talked about, deepening our positions in our core markets and geographies, and from new product development, which has been an increasing source of growth for us. And we've got growth opportunities in each of the 4 major product lines. In household and personal care, it's growth from cat litter. That's a good steady grower for us, and we're growing above the market in cat litter. And then we've got some other smaller, high-margin, consumer-oriented products that we're growing share in. In terms of specialty additives, the opportunity for growth here is really continued penetration in Asia of our products, as well as more sustainable solutions, recycling solutions for paper and packaging manufacturers, and also innovative solutions for lightweighting and bioplastics more recently. On the high temperature technologies side, the growth is coming from penetration in Asia of our blended technologies. So these are underpenetrated markets, massive market opportunity that we've been growing in for a long time, namely India and China, and also these automated solutions that we're selling into the steel market that I mentioned. And in environmental and infrastructure, we've got some really interesting remediation technologies aimed at PFAS specifically, but other contaminants as well, and demand growth from infrastructure-related technologies. So everything from hardening of the grid, that's a big demand driver, but many other sources of growth from infrastructure-related products. So we've got products and solutions that are aligned to key secular trends. The really fascinating and amazing thing about the minerals that we use and the technologies that we can apply to them, we can do a lot of different things for our customers. And we have some of these, we call them beneficial attributes and functionalities that we can help our customers with, but these minerals do a whole lot, and especially combined with the technologies that we apply to them, you can see the list of all the types of things that we can provide, but everything from odor elimination when it comes to cat litter, lightweighting, strengthening when it comes to plastics and things like that, energy savings, recyclability, fluid filtration. And so that results in a new product development portfolio that's two-thirds of the portfolio has a sustainability benefit, either to MTI or to our customers. And you can see on the right-hand side, we've got products and solutions that are targeting all of these key trends. I won't go through all of them right now. Company's got a really strong financial profile. Balance sheet is in great shape. We've got total liquidity of around $700 million. That's consists of cash and cash equivalents of over $300 million and availability on the revolver. As I mentioned, we've been a strong cash flow generator, and that continues to be the case. We target around 7% of our sales to drop down to free cash flow on average. The debt maturities, the debt profiles are in great shape. We just refinanced our term loan A last year in November into a term loan B due 2031, so no near-term maturities. We've got the notes due 28, $400 million of notes. And in terms of capital deployment, we have a balanced approach to capital deployment. And that is, when we're at or below 2 times net leverage, like we are today, we're at 1.6 times net leverage, we look to steer about 50% of our free cash flow to shareholders. That's through our dividend and through our share repurchase program. And we keep about 50% on the balance sheet to continue to delever, but also for strategic M&A. Last year, we increased the dividend by 10%. That follows a doubling of the dividend the prior year. And we also announced in November a new $200 million share repurchase program that we're executing on and will execute on over the next several years. We had a really strong year last year. Sales were relatively flat. We had some mixed market conditions, particularly on the industrial side of the business towards the end of last year. Things started to slow down. However, we had record income, record EBITDA, record EPS. You can see these growth numbers here, pretty significant growth, 16% up on operating income, 10% up on EBITDA, 18% growth on EPS. Pretty strong financial result last year. And this is the outlook we gave at the beginning of this year, I should say, for our fourth quarter earnings call. We do see a stronger year of growth in 2025. There's obviously a lot of uncertainty out there right now, and we guided to a softer first quarter, and it'll actually be softer than last year based on what we guided to. And that's for a number of reasons. Things got off to a slow start, but we're seeing some customers shift around their order patterns, take a more cautious view towards inventories. Some of that we feel is likely tariff related, and just because of the uncertainty out there, customers are taking a more cautious stance. Could also be related to some potential softness on the consumer side as customers are looking to stretch their dollar a little further. But we are expecting a stronger year overall, and we've got a number of reasons to feel confident about that. Namely, it's clear line of sight to growth in cat litter. These are account by account new business that we have line of sight to that we expect to have some growth this year versus last year. And these other high margin specialty consumer products we expect to continue on their growth track. And we're talking double-digit growth levels for these smaller products. And as they grow, become a bigger part of the portfolio, they're having a bigger impact on the overall top line of the company. On the more industrial side of the house, as I mentioned, things slowed down a bit towards the end of last year. So we're starting a little slower there. But we have a lot of reasons to believe that things are going to pick up in the second quarter. We're hearing from customers, particularly on the steel side of things. Our business is majority U.S. Steel, majority in the U.S. Steel market. And we're hearing pretty positive things from our customers in that market for the second quarter. And as well as foundry. Foundry was really affected last year by the agricultural equipment market, so think John Deere type equipment or castings that go into those machines. But things have pretty much leveled off there, and so the business is fairly stable, and we're continuing to grow in Asia, as I mentioned. And importantly, the environmental and infrastructure product line last year, through the first 3 quarters, was down around 15%. And that masked a lot of the growth that was happening around the rest of the company. That product line leveled off in the fourth quarter, and so we're seeing that activity level off, and we're seeing more promising green shoots of potentially seeing an inflection in that product line for 2025. So a lot of reasons to believe here that we're going to see a stronger year from the top line perspective versus what we saw last year. These are the 5-year targets that we laid out at our Investor Day in 2023. Just wanted to remind folks of those. So as I mentioned, expecting the company to grow mid-single digits through the cycle. Margin improvement, our target was to go from 12% operating margin in 2022 to 15% by 2025. We hit that target a year early last year. Okay, so very strong margin improvement for the company, and we're expecting to hold or improve upon that this year. The operating income growth is just a function of the sales growth and the margin improvement. We're expecting continued strong cash flow generation, and we're going to be maintaining a strong balance sheet. So that's really all I had. We think we've got a pretty powerful combination to drive shareholder value at MTI. We do have a strong culture, and it's really a foundation of operational excellence. This continuous improvement mindset is deployed from the top down all the way to the shop floor. Our employees generate something like 60,000 suggestions every year, and we implement 70% of those on average. And each one of those suggestions for improvement represents an incremental improvement that, as a whole, becomes very hard to copy and really helps us maintain our competitive advantage. The MTI business system, just a few words on that. We have a really structured way of running the company. We've got our business units that have full P&L and balance sheet accountability, but we have our resource units that provide all the support that they need to run their businesses. We have a global single instance ERP system that we run all of our transactions through. And so this kind of a fixed cost platform is very efficient. And the reason that's important is we can port in bolt-on acquisitions, we can grow organically without adding significant fixed costs. We've got a great platform for growth in terms of the MTI business system. We've got the global mineral reserves, that's where it really all starts, and the financial strength, which is grounded in the cash flow really, to support all of these initiatives. And so that's pretty much all I had to share for the prepared remarks, but happy to open it up for questions.
Thank you, Erik. That was a great overview of MTX, which is not that easy a company to follow in terms of all of the different markets that you serve. So if we look at pet care, for example, which is the largest category of the household and personal care segment, can you touch on its current size, the anticipated growth rate by region, and discuss the main growth categories outside of pet within the household and personal care category?
Sure. So first of all, should I sit here next to you? Or?
Sure.
Okay. Hi. Can you hear me on this?
Yeah, it is on.
Okay, so yes, the pet care business has grown from something like a $70 million business when we acquired a company called Amcol in 2014 to now it's over a $400 million business. And so it's our largest, by a good margin, sub-product line. And the growth in that business has helped to stabilize the overall growth rate of the company, as I mentioned. And we expect that to continue going forward. We have grown it inorganically and organically, but going forward, what we like about it is, and we primarily play in the private label market, but the private label market for cat litter is growing at 4 to 5% on average. That's in North America and Europe. In places like China that are underpenetrated from a bentonite-based cat litter perspective, it's growing faster than that, 7%. So, and we can grow faster than the market by introducing new technologies and just being a better partner to the retailers and even the branded cat litter providers out there because of the mineral reserves that we have, the operating footprint that we have, and the technologies that we can apply to serve our customers. So it's a great growth platform for us.
You have grown that business via acquisitions. And you added reserves, for example, in Turkey with a white bentonite, which I understand is a high-end cat litter. And then you have recently made acquisitions, one from Canada, for example, and one in the US, I believe. Can you touch on how they are operating and what you see going forward for that particular category in terms of, more acquisitions, diversification, and so on?
Sure, thanks. So yes, we acquired a company called Sivomatic based in the Netherlands that gets its clay from Turkey. So a Netherlands, Turkey-based company. That was in 2018. So that expanded our cat litter presence into Europe. And then we acquired a company called Normerica, a Canada-based company with a US footprint as well in 2021. And that kind of grew, that expanded our operations footprint in North America. So we have a really solid footprint now in terms of North America and Europe cat litter. We're growing organically in Asia in terms of building out some capacity there. So the footprint is there. Going forward, there could be a bolt-on here or there for additional reserves. It's always good to have more reserves, more clay reserves for this business. But we have the footprint established. We have, over the last several years, been gaining efficiencies in these businesses. These were privately held companies previously, and so we've done a lot of work on driving efficiencies, variable conversion cost per ton, productivity in terms of tons produced per hour worked, and we've made a lot of progress and improved margins significantly in that business. So a good portion of the margin improvement that you've seen from the company over the last 3 to 4 years has been coming from the cat litter business.
So just one last question on that topic. You said that China is growing at about 7%. I am assuming it is expensive to ship clay. Do you have reserves in that particular region, or do you need to acquire some?
We have reserves in China, so we have our own mine there, and we also source locally from other bentonite providers there.
Any questions from the audience before I move on to the next topic? Yes, there is. If you could wait for a microphone, please. There you go.
Has President Trump's threatened tariffs influenced your company?
So similar to the previous company that was presenting, we do primarily source and sell locally. And so that holds true for the U.S., China. We are a local provider where we've got, as I mentioned, mines. The supply chain is primarily local to where we're selling, and we're selling locally in those countries. We buy a small percentage of our cost of goods sold, less than 5%, or I should say we import less than 5% of our cost of goods sold. So some of those would be subject to tariffs. We laid this out on our fourth quarter earnings call. It's a couple of $1 million in terms of the grand scheme of things as an impact. And we have ways of mitigating that. We have alternate sources. We have ways of working with our customers to mitigate that impact. What is a little bit more uncertain is potential impact on end markets. And so that's what we're paying close attention to. We serve the automotive industry here in the U.S. We serve the construction market here in the U.S. And so it remains to be seen if there's a significant tariff, say, with the North American countries between Canada, the U.S., and Mexico, whether that's going to impact those end markets. But I would say from a cost perspective, we're relatively insulated.
Water remediation is a hot topic, and PFAS is regularly in the news. Can you update us on your fluorosorb product line, the number of trials and the potential for this category? Do you need regulations, or is demand actually ahead of specific requirements? And who knows if those regulations will be eliminated, but if they are, what do you see companies doing? I mean, I presume they are going to continue moving on in that particular way, removing it.
We think so. So there is a lot of uncertainty right now around regulation and where that's headed. But the fact is we have a very effective product for removing PFAS from water, from the environment. And we've had success with this product already. It's gaining traction. Even this, in the first quarter, we've had success with a large drinking water utility in New Jersey. And the thinking is we've got a good product. It's effective. It's cost effective for the utilities. We have 250 pilots running around the world. And the thinking is if a water utility knows that they have an issue, they're not going to wait for a regulation to remediate it. There'll be enough consumer push for them to want to do it beforehand. And that's what we've seen. The drinking water regulations that are in effect don't actually require remediation until 2029, but we've seen utilities acting before that deadline because they know they have an issue and they want to provide clean drinking water for their consumers.
Well, we have run out of time, which is unfortunate because I had a whole list of questions. But Erik will be available during the lunch, which is about to occur now. We will resume at 12:30 with a presentation with the management of Chemours. So thank you, Erik. We really appreciate you being here.
A quick PSA for you. So I'm Chris Marangi, Co-Chief Investment Officer for Value at GAMCO, Gabelli Funds. And on behalf of everyone at our firm, I want to welcome you and thank you for attending this conference. This is one of a series of conferences that we have on various areas of core competency. Our firm was established in 1977, in fact, as a research boutique. And that's where we started. We have grown into a money manager with over $30 billion under management in separate accounts, mutual funds, including 100% U.S. Treasury money market fund, which is among the lowest cost in the industry. But it really all starts with research. And one of our premier research analysts is Rosemarie here, who has been doing this for 45 years, including, I don't know how many with our firm, but 14 with our firm. And she's done a terrific job along with Wayne in putting on this conference. So I want to turn it back over to her for a very interesting afternoon, and thank you once again.
I'm not sure I want to focus on the 44 years, but so it is now my pleasure to introduce the Chemours company. Chemours was spun off from DuPont in 2015 and has since operated as an independent entity. It trades under the symbol CC. Chemours is a global company with strong market positions in its largest category, titanium technologies, which sells TiO2, a white pigment used in multiple industries, including paper, coatings, and plastics. Thermal and specialized solutions, the second largest category, sells refrigerant and propellants, among other product lines. And advanced performance material sells specialty solutions, membranes, resins, additives, and coatings to multiple industries. We appreciate having Shane Hostetter with us. Shane is Chemours' Chief Financial Officer since 2024. He joined Chemours after 13 years at Quaker Houghton, where he served as CFO since 2021. Prior to Quaker, Shane held several financial leadership roles at Pulse Electronic Corporation. He participated in this symposium in the past as part of Quaker, and it is a pleasure to have him back. Also with us is Brandon Ontjes, Vice President and Head of Strategy and Investor Relations. Brandon joined Chemours in 2016. Prior to his current role, he was Head of Finance for the company. Chemours has 150 million shares outstanding, a stock price of $14.76. That was last night, for a market cap of $2.2 billion, net debt of $3.4 billion, for an enterprise value of $5.6 billion. I will now let Shane discuss the company's operations in the current environment as well as its growth strategy. Shane?
Thank you all. If we can advance to the next slide, that would be great. I think there's a couple more slides. Yeah, the safe harbor, keep going until the first presentation. Keep going. Thank you. So Rosemarie did, introduce both the three segments of Chemours, but I want to dive a little bit deeper into such. As Rosemarie said, the TSS business, Thermal Specialized Solutions side, the real nature of this business, as you think about, people believe, hear TSS and refrigerants, it's Freon, right? Freon is still a key component of ours, but we're really transitioning into an Opteon, which is our new low GWP blend, and really focusing TSS on the refrigerants market. We're going to go deeper into each one of these segments to come, but I wanted to give an overview. The TT business, and Rosemarie talked about the TiO2, a pigment that creates whiteness in paint and plastics and laminates. We are the preeminent player there from a chlorine perspective, and really have a cost-competitive nature from manufacturing, which I'll get into in a second. The APM, or Advanced Performance Materials business, is a diversified group. You can see here the 4 names. Pretty much everybody knows the Teflon name, which I'll get into kind of where we use that now. It's not necessarily in pots and pans. It's really more on the industrial side now. And then other areas around Nafion, Viton, and Krytox, which is a lot of coatings, systematic membranes, and other areas. So getting on to the next slide, kind of giving a financial snapshot of each one of these businesses to kind of put a hold. We have, in total about $6 billion in sales and roughly about $800 million in EBITDA in the last year. And that's broken up, as you see, for TSS about $1.8 billion, titanium TT about $2.5 billion, and the APM about $1.3 billion. To note, right, the other areas here from an earnings perspective, right, TSS does have about a 31% EBITDA margin, and that's really based on the regulatory perspectives I'll get into in a second, that we're able to get those large EBITDA percentages. The other sides, TT having about a 12% and APM having another 12% EBITDA margins. As you think about both of these businesses, really macroeconomically sensitive as we think about peak and trough cycles. And so right now we're looking at an elongated trough in TT, and that's really driving the low margins. As we think about volumes coming through, some of that fixed cost absorption will really naturally increase both their margins. The other area, just to point out from a geographical breakout, we are about 45% domestic from a North America perspective, and then the rest split between Europe and Asia Pacific. So getting into the business a little bit, the next slide goes into TSS. And so, I kind of break the 3 businesses apart and really focus on TSS as a secular business. And the interesting part, and I mentioned Opteon before, right? So breaking this out, and you can see in the key end markets above, right? Whether it's auto, whether it's commercial chillers, whether it's residential. So thinking each one of these differently, right? So the automotive market has now fully switched domestically and in Europe from Freon-based or other high global warming products to low global warming products, namely our Opteon blend. And so there is a bit of a duopoly in the automotive side between us and another competitor that has the same technology, which really is a nice competitive moat as you think about gaining access to this market. The next area to really think about with the refrigerants is stationary and refrigerants in the commercial ends. So probably on the top of this building, there's a chiller. They have to progress into these low global warming products as well this year. So the end, the end producers, the OEMs, the carriers, the trains, they can sell their units with high global warming products this year domestically, but going from a production perspective, they can't produce any of them this year. So it's a big year for us as we think about transitioning from a regulatory perspective in TSS. As we look ahead, we've guided for 25 growth in TSS with Opteon growth in the double digits, and we've talked about, the fourth quarter grew about 23%. We see at least that going into 25 in the Opteon blends. Another area that is within TSS on the next slide is another interesting technology that we believe is really a game-changing technology to resolve some issues in the data cooling side. So if anybody knows, the current data centers are cooled mostly by air and water, with some of the next generations coming through, which is called direct-to-chip, right? So it's steel plates on the actual chips to cool them from a global perspective. This technology is actually called two-phase immersion cooling. So what is that? Basically, the servers are immersed in liquid, right? And so it is self-contained in a fixed asset, and so it's purely circular. So the fluid, the dielectric fluid that we manufacture, it boils when the actual servers get hot and evaporates to a chiller, and then the chiller puts the actual fluid back in. So it's fully circular. So what does this mean? It means not only can we resolve some of the heat issues with the next generation chips, the Blackwells, the Rubens that are coming through, but it also can save a significant amount of energy within these data centers. About 40% of their total energy saves. It utilizes very limited amount of water, and space is really limited compared to this versus the huge racks of servers that are going through now. So there's a lot of solutions here as you think about total cost of ownership, not only providing the solution for the heat exchange. And then the next slide, kind of to round out TSS, I talked about the regulatory attributes of this business, but what you can see here is it's not just a one-stop, right? It's going to continue as we think about more regulation around global warming as it relates to these refrigerants. And we've really excited about the Opteon transition, but we're also investing in the next refrigerant that as this steps down and there's more requirements around global warming, so that as we think about just continuing to see growth in this attribute, we're continuing to invest in next generation refrigerants. Getting into TiO2 and our TT business, here's a bit of a snapshot for that, where we think about major segments, primarily in the coatings manufacturers, and North American about 40% of our business, with Asia and Europe being the other two larger areas. I think if you know TiO2, right, it's in a bit of a trough area at the moment, right, and we're eagerly awaiting some housing restarts, as well as more economically or more domestic in Europe economic spursion. But I think the big takeaway for TiO2 and our TT business is we're controlling what we can control. So we took out $140 million of cost last year, which is a total 190 over the last 2 years, to really make sure we're optimizing the production and the manufacturing capabilities of this business. So when volumes come back, we can utilize that renewed structure to really balance and think through how to grow those margins and grow those earnings. So we're very excited about this business as well. And then going into advanced performance materials in the next slide. Oh, another slide. So I think the easiest way to kind of talk about this is we look at it between what we call performance solutions versus advanced materials. And you can look at it at the bottom. Right now, advanced materials are roughly 60%, performance solutions about 40% of this business. So the performance solution side is really the emerging markets, whether it be we talked about Teflon branded for the semiconductor industry. We are the only domestic provider of the Teflon, it's called Teflon PFA, and it's utilized in the actual processing of the semiconductor nodes. The other areas that we're very intrigued in the performance solution side is EV batteries. We have a unique battery technology for the dry process for the cathode and anode basis. And then other electronics focus, and we also have some hydrogen assets within the performance solutions side. To note, we have delayed investment in those businesses as we put in forth on Q3, just based on the market slide for green hydrogen. The other area is advanced materials. This is a lot of the legacy area for gaskets and things to that extent, as we think about the actual industrialized PTFE and PFA that go into automotive, construction, households, et cetera. I would say, and I'll get into the strategy of the company, the corporate strategy in a little bit, but there's a pillar within the corporate strategy. It's called portfolio optimization. And really what that is meaning is looking at our portfolio from a return basis and thinking through and making sure all of these product lines are positioned correctly from a pricing perspective and a cost perspective, but also thinking through, how to utilize and unlock value there. And I think in this advanced materials portfolio, there's a lot of that as we think about really making unique selections and decisions in this business. On the next slide is just kind of a picture, and really thinking through capital allocation for the company is very focused at the moment, right? We talked about a little bit of the debt that Rosemarie talked about, that we have about $4 billion net, $3.5 billion of cash. We're levered up about 4.4 times. So our capital allocation priorities are very focused on only strategic growth areas, first more, balancing that with debt pay down and liquidity management. And so when I put this picture up here, really we're very focused on that secular, or the growth industries that we feel like are going to carry us forward in the next years, whether that be EV, semiconductor, electronics. And then also helping grow the TSS side, whether it be in the Opteon or the next generation of refrigerants businesses. Getting into the financials a little bit. And the next slide. Keep going. So the fourth quarter, we printed a very nice quarter, 1.4 billion of sales. And as I think about adjusted EBITDA, we rounded out at about 179 million. That exceeded consensus and expectations across each one of the businesses. And it was really driven by good TSS growth, as you kind of see up here. The TSS business, specifically the Opteon refrigerants, grew 23% year over year and 14% in total for the year. And then it was also focused on the backs of really cost activities and really focusing on spend. And as you see, TT adjusted EBITDA was up 20% in the quarter and 8% year over year. And that's really in the backs of these cost savings activities that I've talked about. And then APM similarly up 20%. And the real focus here with APM is really on that portfolio management and thinking through whether the businesses are in advanced materials are the attributes that we really want, or is pricing or cost where we want to optimize. And then just thinking of the full year rounding out, Chemours had some tough times in the beginning part of 2024. There was a transition, with management. I'm new here. I've been here for 8 months. Denise Dignam's been here for a year. And we're really excited, to have us in the standing leadership positions and everybody from an executive perspective to be fully filled out and turning the page into 2025 to fully execute our corporate strategy that we initiated in the third quarter of last year. With that, I'm going to get into the corporate strategy a little bit on the next slide. So there's 4 pillars of a strategy that we have entitled Pathway to Thrive. So the first pillar of operational excellence, to note, we are initiating a cost out program. We've put 250 million of a target over the next 3 years. And that's actually split with $125 million of cost out this year, with that being run rate into 26. So we'll see some cost savings this year, but run rated into 26 of 125 million. By business, we see that split half between TT and the rest between the other 2 businesses and the functions. The next pillar, enabling growth, really is around commercial effectiveness and excellence, and really sharing amongst the 3 businesses on how to really gain efficiency on gaining share and taking things through and making sure to do that at the right price. And we are targeting above a 5% sales CAGR over the next 3 years. The third one I talked about already, but just to kind of hammer home about portfolio management and optimization of the asset footprint of this company. We initiated a strategic review of our European assets in the fourth quarter, and that really is focused a lot on the APM side, as they have the most heavy manufacturing footprint in Europe. We shut down 2 lines in APM already, and that was really on the backs of looking at, are they accretive, and do we really want to spend capital to make sure that they're utilizing that side? And it was quite clear that they were not strategic for us, and as well as that it was accretive for us to shut them down. And we continue to look through how to optimize that footprint and that portfolio to really create shareholder value. And then the last pillar, one area which we have not touched on, which I know Rosemarie probably is going to ask questions on, will be the PFAS and legacy liability area, right? And so for those that don't know, Chemours was a spin from DuPont, 10 years ago. And with that, we did get the legacy liabilities associated with the PFAS-related areas. And so I felt it, coming here, and Denise and I really wanted to see how we could be more transparent around these liabilities and really box them in a little bit on helping, potential shareholders and shareholders think through how to believe them and see them in the future. So we look at this in kind of 4 buckets for legacy liabilities. One would be water-related areas. And so with that, we actually settled the majority of this bucket last year with the AFFF Water District settlement. And we settled that for about $600 million. That was our piece of it. And as you think about that on a much broader scale, right, the 3Ms had $13 billion in this settlement. So yes, it's a big item for us. We get past it, but we are still a little bit on the smaller end as it relates to some of this as well. The next kind of bucket I look at is the natural resources and related areas. And that really, as you think about, is in the states that we operate. And we operate in Ohio and Delaware, which we've already settled. And the 3 that remain to be settled are North Carolina, West Virginia, and New Jersey. And so those are the three areas we're really focused on. And people, it's in the news, there is a trial set for May as we think about this for New Jersey. So that's really the next kind of step ahead. And I know Rosemarie's probably gonna have a question about that, so I'll talk about that a little bit when we get there. And then the third bucket is personal injury. As we think about the personal injury side, there is a Daubert case coming up the latter part of this year, which really kind of starts, the Daubert case is something that would give you an idea of what the cases would look like going forward. I would say between the states and between this, we're actively, in discussions with the regulators and thinking through, the best path forward for them, but also for us as we think about the negotiations of, financial implications. We feel very strong that we can get to good settlements and good thoughts ahead, so more to come there. The fourth bucket we just kind of talked about is property, which we believe is the minor area. It's more kind of ancillary property to where DuPont manufactured the PFAS, and really property-related claims that probably is the least amount on this bucket. And so as we think about just dynamics in the third quarter, we talked about this, we bucketed them. We also talked that we believe when we materially pass these liabilities in the next several years. And that was big for us. I mean, that was the first time we've even talked about timing or how we have momentum in this. And I really wanted to put that out as a stake in the sand to make sure that people understood we're looking at these, we're eagerly trying to mitigate them and get through to help get this perspective past us as a discount to our stock price. And then the lastly, I just really wanted to update kind of, we set that corporate strategy. What do we do, in the fourth quarter, and how's it progressing, right? So key takeaways here, from the cost out and operational excellence, right? I talked about the TT transformation, whereby we got out $140 million of cost last year. So we continue to optimize that. We initiated corporate reductions, we call it the ZBB, which we have, targeted on that. So I think the takeaway here is we're getting off the ground running as it relates to the cost efforts, and we feel very good about the targets we put forward. The enabling growth on that side is, we talked about the double-digit area we got in Opteon last year, 23% growth in the quarter. And as I think about a key element to this enabling growth, we are expanding capacity in our Corpus Christi facility, which manufactures the Opteon brand. And that's a key component to continue these growth initiatives, and really came out of the expansion really successful and hitting 2025 running with really good production. And then the third one with portfolio management, we talked about, where we did have a European asset strategic review announcement, and the two lines have reduced. And then finally, strengthening the long term, coming out one area, the liabilities, we continue to negotiate. We settled Ohio, we settled AFFF last year. The other area coming out of the issues of the first quarter with former management, we did have controls and process-related issues that we had to remediate from an accounting perspective, and we fully mitigated the four material weaknesses by the end of the year, which was a key initiative of mine when I came on. So all in all, just to kind of cap this off before I hand it over to Rosemarie for questions, really excited to be with Chemours. Really excited to put 24 past us and look, to really execute upon our strategy and really create value for this company going forward. So I'll stop there and hand it over to Rosemarie. Okay. Awesome. I would love to join you.
So thank you, first of all.
Absolutely.
And thank you for addressing the elephant in the room right off the bat. And just staying with that topic, right? Wayne may have a question, but I was regarding the total liability. You say 600 million, but somehow it sounds low. I don't think that was the...
Yeah, maybe I clarify.
Yeah.
So the 600 million was already settled, Rosemarie, right?
Okay.
And I think a popular question is, hey, can you help me quantify the liabilities in total, right? Unfortunately, we cannot give a number. I mean, it would be unfortunately disadvantaged for us as we think about, the legacy liabilities and negotiating settlements, et cetera. So there is no public number, right, for that. We do have an MOU with DuPont, right? That was a $4 billion MOU to which we've spent about $2 billion on it to date. So there is $2 billion left on that MOU, which we would split, half and half from that.
So what happens if eventually the cost is above that $2 million left over. Is it going to be 100% your responsibility, or do you need to go back to DuPont and say, okay, hey, we want to change that system one more time?
Yeah, no, it's a good question, Rosemarie. Right now, right, it's $4 billion. What I would say is before we got into the MOU, right, we settled several cases, and we split those cases with DuPont, right? So I think the precedent would be to say that, you know, not only now this MOU, I think there's good precedent there.
So following up still on
Sure.
that topic, you are still making PFAS. There are two main categories that have been regulated. There are another four small category which have been regulated but at a higher acceptable level. Can you talk about the difference between what you are making today versus what has been banned, and why is it not going to be an issue in the future?
Yeah, sure. I think it's important to say, I mean, there's about 5,000 different PFAS components in the world, right, on this side. So, you know, not everything is, you know, what you're talking about, right, where it's consumable and in your body and that side. That's where you really get in trouble as you think about PFAS. We're really on the industrial side, right? And it's really important to also say, I mean, the world can't operate without PFAS-oriented areas. I mean, I have my iPad here, cannot be created. You have a microphone there. It's everywhere around you on this side. We're very much dedicated to science-based targets as it relates to the PFAS-oriented sides. We're a manufacturer of this. We believe in fluorinated chemistry, right? The fluorine-carbon bond is one of the strongest in organic chemistry, and you can't manufacture items without it. So we're very much dedicated to it. That said, the science-based targets, we work with the government, the EPA. We receive regulated permits. You know, to this day, we just got a permit for our Teflon PFA manufacturing in West Virginia, right, with coordination and coordination of that. So we're dedicated in making sure that we're operating efficiently and within the standards that they're set by the EPA.
All right, thank you. So maybe we will move on to another topic. So the titanium technologies is your largest segment. Can you talk about the TiO2 environment currently, including demand, the competitive landscape, especially given China's substantial imports of cheap TiO2 into the US and Europe?
Yeah, absolutely. So one thing, right, so I just want to make sure we bifurcate, right? Our technology is a chlorine-based technology versus, you mentioned China, right, which is heavily sulfuric technology. So there's two plays to play there on that side, right? And we're very happy with the capacity we have and the footprint we have, both domestically and in Mexico. Now, with that, as you think about just the landscape, obviously, you know, the China capacity is one thing that's always been on everybody's mind. There's a lot of effort with the anti-dumping duties and tariffs around the world trying to mitigate some of the exports that are going on that side. You know, as you just go around the world, Europe obviously put in, you know, the 36%, you know, tariff on that side last year, which we're seeing some inroads and help with mitigating some of the exports with China. You know, if you look at it sequentially, it is going down. If you look at it year over year, it's a little bit more tougher of a comp. Now, there's other tariffs going in, whether that be in India or Brazil, which I think helps mitigate some of the other areas. But there is a little bit of a, for lack of a better word, whack-a-mole going on right now, right? You put a tariff in, and are they going through other avenues? And that's what we're mitigating as we see, right? So, you know, though, you know, the capacity is there, we're going to control what we control. And I talked about the cost out programs of this company to make sure we're optimizing what we can control until the market comes back and until customers renew some of their inventory.
Any thoughts of reducing the amount of capacity that you have in order to deal with, you know, a shrunken industry, for example?
So we've obviously will look at everything that creates value for our shareholders, but right now, you know, we did reduce our capacity in 2023 by shutting down our Taiwan facility, right? And we were able to absorb that capacity mainly in our Mexico facility in Altamira. And that was a strategic area that has shown us a lot of good cost reductions and a lot of good optimization from an efficient capacity perspective. But right now, with that shutdown, we are pretty happy with our footprint and believe we, you know, are optimizing that, and we could serve, you know, when demand comes back as well.
So we are. Oh, sorry, there is a question from Wayne.
About the Opteon for data centers. It's very different Are you the only ones with that technology? What are discussions like going with customers so far, and what does the commercialization look like on that?
Shane, I didn't plant that question, just so you know.
No, it's a great question, and we get that question quite often. So as far as competitive landscape goes, right, so two-phase immersion cooling, there is another product in the market that people point to. It's an old 3M product, but it's not the same type of product, right? The 3M product was actually a foam product that was applied to two-phase immersion cooling and applied to that via another process. We manufactured the Opteon molecule, this specific Opteon molecule, for two-phase immersion. So what's the difference and what's the benefit? What you see is really more corrosion on some of the other areas, and corrosion when you're immersed in fluids is not good, right, from a server perspective. We've manufactured this molecule so that there's no corrosion issues and that it's fully self-contained. And also 3M has obviously publicly said that they're getting out of PFAS and getting out of this molecule, so we will be the only individuals with this competitive dynamic and product online. We have said commercialization in 2026, end of 26. Key steps there are obviously manufacturing footprint and supply, which we're hoping to discuss more transparently to shareholders in the months to come.
There is another question in the audience.
Just a quick question on titanium TiO2. Will the recently announced Tronox shutdown in Europe have any material effect on the supply side?
Yeah, it's a great question. I think the shutdown obviously is balancing their capacity and thinking through, what the actual supply side looks like. At this point, I think people are asking a lot about capacity, whether it be in China or, shutdowns in there. I don't see it as a significant impact to myself, right, to Chemours in this side. I think there's an opportunity here as we think about share in Europe. So if I look ahead, I really am just thinking that it might be positives for us. The market is a lot of TBD on where capacity might go in China, to be honest with you.
So still on TiO2, you mentioned that you have lowered your own inventories and you are satisfied where you are. Can you talk about where the overall industry is? We are getting into the spring and summer season. Usually there is a higher demand for coatings with a problem with high interest rates. Housing is not really that robust. Can you talk about what you see in this environment?
Yeah, sure. As I think about just overall demand and potential, I obviously we will see the seasonality come through in the spring demand, in the second quarter, and we've indicated such. Now, do I think there's a restock or any of that such coming? I think customers are looking ahead and thinking through and balancing strategic decisions based on where the market environment goes. And there's a lot of complexity and a lot of ambiguity going on right now. So though we're cautiously optimistic that they'll see a little bit of growth in the back half based on market conditions, we're going to, see where we go. And I don't see a major restock as we think about in the second quarter, though I do see customers' inventory still being maintained at a lower level. So that restock could come, in the future.
Are they buying mostly on an as-needed basis? Do you see that happening instead of building up inventory?
We do. Yeah, I think it's more on an as-needed basis versus building up security and inventory supply.
And so we still have any other questions from the audience? Yes, Keith?
Yeah, first of all, Shane, thank you for the overview. I think it's actually really interesting. On PFAS, by the way, I think it's also included in pretty much every space component,
yes,
right?
Absolutely.
Right? So it's pretty important. You on the liabilities, though, one of the things you did not talk about, I think, was the potential European exposure. Could you help quantify for us what the European liability could be for the company and sort of where that is in the state and status? My understanding is that you've got each country, has its own element here, and I'm just curious what that is from your perspective.
Yeah, no, it's a great question, Keith. And from a European perspective, it's state by state, and it's mainly where we operate, right? And so when you think about where we operate, there's not a lot of individual areas. It's mainly focused on several key countries, Amsterdam being one of them, as we think about the PFAS components there. We're in active discussions with those states, and I think, as you look at our public filings, we've done a lot to mitigate community efforts, whether it be activities in the community or resolving such. the quantification of that's quite difficult because it's not like the federal level when you think about EPA or in the other side in the U.S. And we have not put numbers out, but we feel like it's less than what we would see in, far less what we see from a U.S. perspective, and that's really the only quantification I can kind of give, Keith.
Very different litigation structure, very different regulatory structure. Exposure is typically a lot more contained, and it's more based on the municipality, and we've had some recent events with like the Kitchen Gardens Reserve and things that are on our books as well.
Shane, we have run out of time. Again, I go overboard, but thank you very much for your really informative presentations. And Brandon, thank you for joining us as well and contributing.
I just want to share, if you haven't seen the two-phase immersion cooling opportunity or the technology, it's on our website. There's a video that explains it. It's pretty exciting stuff.
All right. Looking forward to looking at it. Thank you.
Thank you.
It's a pleasure.
Oh, perfect. I'm going to introduce you and then just to make you, my last name is pronounced Glajch. Okay, no problem. Good. Thank you. Perfect. Doesn't bother me. It bothers everybody. Got it on my screen. There we go. Yeah, so it's just that one forward? Yeah. Got it. I'll introduce you.
Okay, so moving right along, next up we have Orion Engineered Carbons. Orion, headquartered in Luxembourg, but with its executive offices in Spring, Texas, is a leading global manufacturer and supplier of carbon black products. Carbon black is a solid form of carbon produced in powder or pellets and is used to create a variety of desired physical, electrical, and optical qualities of various materials. Carbon black products are primarily in the form of rubber carbon black, used in the reinforcement of tires and other rubber applications, and specialty carbon black, used as additives in the production of polymers, batteries, printing inks, and coatings. Orion is one of the largest global producers of both. Orion has around 57 million shares outstanding, closed yesterday at $13.90 for a $792 million market cap, net debt of $860 million for a $1.65 billion enterprise value. Joining us today is CFO Jeff Glajch, and VP of Investor Relations, Kapsch. Jeff joined Orion in 2022 and has over 30 years of experience leading corporate finance and accounting functions for both public and private companies, including Graham Corporation, where he served as CFO for 13 years prior to joining Orion. And Chris joined Orion last year as VP of Investor Relations, following nearly 30 years in institutional sell-side research focused on specialty chemicals. So I'll now turn it over to Jeff for an overview of Orion.
Thanks, Wayne. So we've got our safe harbor statement, which I'll quickly go by. Carbon black. Carbon black is in a lot of different products. We talk about it being in tires, being in rubber, but it's in a lot of other products. It's in coatings, it's in fibers, it's in batteries, which we'll talk about a little more detail later. So it's a very well used product across many different many different areas. We have 15 manufacturing sites. One of the things about carbon black, it can be transported across the world, but particularly the rubber products typically are manufactured and used in the same region. So as you can see, we have manufacturing locations in the Americas, 5 in the Americas. We have, I believe, 6 in Europe and EMEA. We also have ones in Asia. We're currently building another plant in La Porte, Texas, which I'll talk about in a few minutes. Orion has a revenue of about $2 billion. We are the largest specialty carbon black manufacturer in the world, and we're the 3rd largest rubber manufacturer in the world. So we have value proposition. We believe it's a very important long-term value proposition. Particularly the rubber market is very resilient. You don't see the rubber sales drop dramatically in a recession. You don't see them spike too high in a stronger period. It tends to be a pretty consistent long-term business and very resilient. Our specialty business is really driven by the end markets that we're in, and sometimes they're very strong. Sometimes some of them are strong, some of them can be weak, but Overall, Orion has got a very resilient profitability level and very predictable as we move forward. As we're looking forward, one of the important things about Orion, we currently have EBITDA of about $300 million. We have the capacity by the end of this year and entering 2026, we have the capacity to earn $500 million of EBITDA. How do we do that? We need to fill up some of the facilities that are a little underutilized right now, as well as our new plant in LaPorte, Texas. If we can do that, we can move from the $300 million range, which is a new plateau we moved to a couple of years ago, up to as high as $500 million. And a key point in that is our ability to generate free cash flow. For many, many years, we had to reinvest in this business, first for some required emissions investments here in the United States, and then more recently for some growth investments in Italy, in China, and a plant in LaPorte, Texas that we're currently building. When those are done, at the end of they're all done except for the LaPorte plant. When the LaPorte plant is done at the end of this year, we will be reducing our capital spending, using that runway that we have to get toward the $500 million of EBITDA, and ultimately generating a lot more free cash flow. And that, we believe, is an important inflection in the Orion story. As you can see, our profitability level, other than the 2020 dip due to COVID, has actually been pretty consistent. But importantly, over the last 3 years, were the first 3 years that we had ever gotten our EBITDA over $300 million. And we've been consistent in that, despite some pretty significant headwinds in our end markets. Specifically, if you look at the rubber market, which are primarily tires, if you look at the tire market, the imports coming into the United States have increased very significantly over the past 2 or 3 years from their normalized level. This is because the consumer is looking for cheaper tires, and some of our customers have not reacted as aggressively yet. When they start to react, and/or when the consumer moves to higher value tires, that will allow us to fill up some of the available capacity that we have today, and ultimately allow us to move toward that $500 million of EBITDA. In the rubber market alone, we believe we have about $80 million of available EBITDA just by filling that capacity. So talking about rubber carbon black is about 2/3 of our revenue. About 70% of it or so goes into tires, and it's not just car tires. It's car tires, it's truck tires, it's heavy operating equipment. And then beyond looking just at the tire side, when you're looking particularly at the car tires, it's mostly replacement tires. If you think about buying a new vehicle, you buy a vehicle, how many times do you change the tires out? Typically 3 or 4 times. So about 60% of our volume, roughly, in the rubber market is replacement tires. And the other roughly 1/3 of the business beyond the tire side are mechanical rubber goods. So if you're looking at a vehicle, you're looking at the dashboard, you're looking at the sealants around the windows, the hoses within the vehicle. If you're looking at an EV, you don't have a lot of the hoses, but you do have the mat that the battery is on top of. So these are all important end markets for us, and so a lot of it's driven by vehicles, but it's not necessarily driven by OEM vehicle sales. It can be it's the replacement tires, as well as obviously the freight market and the truck tires. Growth drivers. Traditionally, you've had miles driven, tire production. Those have been what's been driving the tire market and the rubber market for us in the past. But as we look forward, the transition toward EVs on the rubber side, if you think about an electric vehicle, it doesn't have the hoses, but it's got a mat for the tires, or for the battery, I'm sorry. But then you look at the tires, and if you think about EV tires, they're heavier. The vehicle's heavier. Typical EV weighs about 1/3 more than an internal combustion engine vehicle. You also have greater acceleration. If you've driven an EV, or even if you've driven a hybrid, when you accelerate, you get a quick start from the stop. And that quick start is friction, and the friction is wear on the tires. So if you look at a car vehicle like a Tesla, or if you look at a truck like a Rivian, the tires do not last anywhere near as long as they do on a regular internal combustion vehicle. So that's an important change, as well as the design of the tires. So all of these are positive things for us as we look forward. Specialty business, about 1/3 of our overall revenue, and it's a lot of end markets. It's the biggest end market for us is polymers, and polymers is a pretty broad end market. It tends to be mid to kind of lower end of our specialty business. But then we have the coatings market. So if you look at a very high sleek black car. Of course, you've got the black, but you've also got the kind of blue undertone. That's a tremendous market for us. The fiber market, the athletic wear that's worn primarily by women, but also by men. There's carbon black within those. There's the ink market. There's the battery market. The battery market's a very, very small volume for us, but it's a significantly higher profitability per ton of product. So all of these are important markets for us in the specialty arena. We're heavily weighted in Europe and Asia in the specialty markets, a little underweighted here in the United States. The growth drivers for specialty, again, consumer demand and some of the headwinds that we've seen globally have impacted us over the past couple of years. So we think that eventually will turn. It may not turn immediately, but it could eventually turn. One of the questions I often get around the consumer market, but specifically the European market, is the fact that carbon black has now been banned from being imported into the EU from Russia. What happens if the war ends in Ukraine? Well, first off, if the war ends in Ukraine, that's a very good thing for humanity. We should all be happy about that. And it's beyond our quarterly or annual results. But if that does happen, two things. One, we believe that consumer confidence in Europe will go up very significantly, and that will help on the consumer demand side. And then secondly, the product that used to be imported, the carbon black that used to be imported from Russia, that is no longer allowed to be imported from Russia because they put a ban on it last summer, has been replaced from imports from Asia. We believe if Russia is back into the European market, the Asian imported product will probably cut back some. Why? There's been very significant supply chain issues getting product from Asia into the European market. So we believe that ourselves and our other European local competitors will continue to keep our market share, and the import piece will just move from one to another. As it did when it moved from Russia to Asia, it'll just move back from Asia to Russia. But that's more speculation on what happens in Ukraine. Sustainability. We are actually the leader. We believe we're the leader within the carbon black area in sustainability in a couple of ways. One, on the specialty side with the high value specialty, high value, high purity specialty products that go into EV batteries, for example. That's a key driver market for us going forward. Also, if you look at sustainability from a rubber market side, we have tires. We're working with the EU. We've worked with Michelin on a project called Black Cycle, which focused on how do you take and recycle old tires. We are continuing work in that area of sustainability with some work that we've got that's been funded by both the German government and the EU. So we finished 2024, and now we're looking at 2025 and beyond. I want to talk a little bit about 2024, but more importantly, where we're headed in 2025. So as I noted earlier, we had our third year of EBITDA of $300 million or above. First time we ever did that was 2022, so we've got 3 years in a row of it. We're really pleased, despite the fact that there's been some pretty significant headwinds in our end markets. And one of the key things here, one of the key metrics we look at is even with that higher level of EBITDA, we're looking at rubber demand 15% below where it was pre-COVID. Why? Imports into the United States from Southeast Asia, imports into the EU from China. Both of those have been pretty significant headwinds, even though consumer demand has improved on the tire side because it has to, because you have to replace tires. The reality, they're buying cheaper tires from imports. We think that will change over time. I think another important point I talked about a little bit earlier, we have $100 million of available capacity within our system. 80 million of that on the rubber side, 20 million of that on the specialty side. If we can fill up our existing plants, we can move that EBITDA number from the low 300s to the low 400s, just simply by that demand. And then if we include the plant that we're building in La Porte, Texas, there's another $40 million of EBITDA opportunity there. And then we have some additional opportunities to grow profitability by upgrading the quality of our product portfolio. Biggest challenges, consumer confidence and inflation. Consumer confidence has been a headwind in both the Americas and in Europe, and inflation has driven people to lower value tires. What does that mean, lower value tires? They buy cheaper tires, they don't last as long. Their long-term cost of ownership may actually be higher, but their short-term what do I have to pay today to buy a tire is lower. That trend needs to change. And then finally, customer forecasting. You know, when you put out guidance at the beginning of the year, you're always challenged, and if you have to adjust it as the year's gone on, as we've had to the last year and a half, it's really a function of our customers looking at their view at the beginning of the year and then their view at the end as the year goes on, and it has been falling. Hopefully that's been stabilized and that won't be as much of an issue going forward. Market observations in 2025. The replacement tire market, I've talked about that already. On the car side, on the freight side, we believe if we start to see an improvement in manufacturing at some point, perhaps not early, but at some point that can help the freight market. The geopolitical, there's a lot of uncertainty there. I talked a little bit about the war in Ukraine, but there's just uncertainty whether it's tariffs. We're not planning for tariffs. Tariffs are a benefit to us perhaps, but we're not planning for tariffs. And just that uncertainty out there. So our view is we can't affect that uncertainty. That's beyond the control of what we can do. But we're gonna be agile in our business, and we're gonna make sure that we can affect what we can change and what we can improve, and we'll address the market if it changes. And then finally, the specialty market. We saw growth in 2024. That was a good thing, but most of the volume growth was at the lower end of the portfolio of our products. We believe going into 2025, we'll see additional growth, but it'll be at the higher end. Why will it be at the higher end? Partly the end markets and partly some debottlenecking projects that we've done over the past couple of years that have given us additional available capacity of high-end products. In fact, so we're focused on what can we do. There's a lot of stuff we can't control. We can't control the end markets. We can't control foreign exchange. What we can do, though, is the things that can improve our business. So our rubber contracts, we've seen a significant improvement in our rubber business over the past couple of years as pricing has improved in the rubber area. We continue to focus on how do we get additional lines from our customers, as well as how do we make sure that the pricing improvement that we've seen is not a spike. We don't believe it's a spike. We believe it's a change in the structure of the market. We put a cost reduction program in place at the end of 2024, early 2025. That's been essentially completed now, and we're moving forward. We reduced our headcount of our non-manufacturing personnel by about 6%. Just something that you have to do every once in a while. You have to look and say, have we added a little bit too much? Maybe we need to cut back some. We've had some operational issues at our new plant, particularly in China. Of those we believe are now resolved. We expect to pick up $10 million in EBITDA this year from our plant in China. We believe there's another $10 million at least available to us beyond 2025. So we're focused on things that we can control and focused on growing our specialty business, as I talked about before with our debottlenecking projects that we've done, and trying to improve our product portfolio. And then finally, the last thing is operational excellence. We've been investing in maintenance capital the last couple of years. We will continue to invest in maintenance capital. This is a business that historically, as an industry, had been under-investing in maintenance. We've changed that tune in the last couple of years, and we will continue that going forward. That will give us additional capacity. It will also give us additional productivity. I'm going to pass on this slide because I'm a little tight on time. Very quickly, our guidance for the year is $290 to $330 million of EBITDA. The 290 is a little bit lower than last year. Part of it is really driven by foreign exchange. If you took last year's results adjusted for foreign exchange, when we set our guidance, it would have been about 290. So what we're saying is on the downside is a flat market, on the upside is growth in the low double digits. Very, very important story for us going forward is free cash flow. And free cash flow starts with profitability and then follows with where do you spend that cash that you earn. And if you can see here for the past 4 or 5 years, we've spent a lot of money in capital. We spent over $200 million a year, most of the last 4 or 5 years. We've spent on maintenance. We will continue to do that. We had to spend on the EPA projects. Those are done. Those finished up at the end of 2023. We're done with our EPA capital spending. A couple of our competitors still have spending going on both in the U.S. as well as in Canada, which what that will do is have them not only them spending cash, but that will also help us in the market, because as we all spend capital, ultimately the end user pays for that by higher prices. So that will help us. We've also spent a lot on growth capital in the last 4 or 5 years. I talked about the plant in China at our Huaibei facility. We made an investment to expand our facility in Italy in 2021 and 22. And now the La Porte, Texas acetylene-based product plant that we're building right now will be finished by the end of this year, will be started up in 2026. That's been a significant usage of capital in the last couple of years. It's a significant use this year. It'll be done going once we're done in 2025. What does that mean? Well, you can see our capital spending from 24 to 25 is reduced almost $50 million. That's going to become free cash flow for us. And then another $50 million as we go into 2026. And our expectation beyond 2026 is this lower level of capital spending, which will generate more free cash flow for Orion. My last slide is really just looking at the free cash flow story. And this is the inflection point in the business. This is from an investor standpoint, this is probably the most important thing. You've gone from, in 2024, where we had a use of cash of about $40 million, to 2025, we're improving that about $100 million. Half of that is lower capital spending. There's a little bit, we believe we've got a little bit of improvement in working capital, a little bit in our taxes, and the EBITDA numbers relatively the same, but $100 million improvement in free cash flow. And then as you go to 2026, another $50 million beyond that, which is that reduction in capital spending. Now, if you look at this, we say higher EBITDA, but we don't put a number on it because I'm not going to put out guidance for next year. I've already put it out for this year. But if the benefits of the investments that we've made are able to come to fruition, as well as the improvements in some of our end markets, we believe that free cash flow number will grow even further as EBITDA grows, and that $100 million can be much, much higher in 26 and beyond. So with that, if there are any questions.
Okay, so we'll open it up to questions. I'll start off if you want to join me here. So you mentioned the resiliency of the tire market. You can't put off replacing tires forever. I know that all too well, driving up from Long Island to our office in Rye every day. But there's been headwinds with, as you mentioned, the Chinese and South Asian tire imports into Western markets and Europe. With all the tariff noise going on right now, can you discuss any impacts on Orion and with the EU and US potentially looking at anti-dumping actions? When can we see action on that? And is that baked into guidance for this year? Or any potential benefits that you could have from that?
Sure, great question. So a couple of things. First off, if you look at the Western tire markets, and we are overweighted in the Western tire markets, the U.S. has already tariffed Chinese tires out of the market. So what comes into the U.S. comes from Thailand, comes from Indonesia, comes from Vietnam, primarily in the Southeast Asian countries into the U.S. Into Europe is primarily Chinese tires. If there were actions on tariffs, not in Chinese, but on Southeast Asian into the Americas, or from China into Europe, if there's actions either way, that will benefit our business because we have, particularly in the Americas, we have excess available capacity to meet that. We haven't planned that. We believe that planning on a tariff or government action that has an unknown idea, an unknown time frame would be foolish on our part. That's something that's ultimately going to have to get pushed by the administration, whether it's here or the EU, as well as perhaps the unions sometimes are also driving that to push the administration. So there is significant upside. That $80 million of available EBITDA from rubber, you could get a significant amount of that if we saw tariffs either from Southeast Asia into the U.S. or from China into the EU.
So what else would it take to get to that full 80?
Sure. I think the other thing that would have to happen is that import level would have to come back to normal. If you looked historically, and I'll use the U.S. as an example because the data is probably the best data we have, typically you see about 52% of tires being imported into the U.S., and that's a pretty constant number. In the last year and a half, that number has raised up to close to 60%. If we could get back to that normalized number in the low 50s, that alone would give us significant additional volume on the rubber side that would help us. How does that happen? Certainly tariffs is one way. Convincing the consumer to buy, the tire companies convincing the consumer to buy more expensive tires, but one that will last longer and ultimately their long-term cost of ownership will be lower. That's another way it can happen. And then a third way is perhaps some of the higher-end tire companies. You know, it's great to have an 80,000-mile guarantee on your tire, but there's a lot of people out there who don't want to buy a tire that has an 80,000-mile guarantee. Perhaps marketing their second-tier brands that have a 30 or a 40,000-mile tire a little harder, that also can drive demand. So there's a lot of things that can drive that incremental demand, which is incremental supply for us on the carbon black side.
And it's probably worth adding one thing also. Our tire customers are committing capital to reshoring activities. So they're spending more money making their tire factories onshore in North America or in Europe. And so that commitment suggests that the demand, that they see the currently elevated level of imports as somewhat transient.
I could use the 80,000 guarantee.
But pay for the 40.
Yeah. With reshoring dynamics in the U.S., there's some tire production being brought online. Is there any risk to more carbon black production being brought on? And can you talk about kind of your competitive moat there?
Sure. There are right now. There's a little excess supply in the Americas market. Should we have that movement toward less imports and more production or more onshoring, that'll quickly get eaten up. No one has made an announcement or made a decision to build additional carbon black capacity in either the Americas or in EMEA, with a few very minor exceptions, and that is we made a small expansion in Italy a few years ago. One of our competitors added 200 KT around the world. They added 40 KT into an existing plant in Hungary. 40 KT, by the way, in the European market is 2% of the market, so a very, very small increase. Nothing in the Americas, with the exception of there's a private company called Monolith that is looking to, rather than using the bottoms of a refinery or using coal tar as the raw material, they're looking to use methane as the raw material to make carbon black and also to make hydrogen. There's been a number of articles in the Wall Street Journal about it. Their capital cost compared to building a carbon black plant, a pure carbon black plant, is multiples of what it would cost to build a carbon black plant. We kind of think of something in the range of $2 million per ton to build a carbon black plant. So if you were building a carbon black plant that they've announced of 180 KT, it would cost you $350 to $400 million. According to the Wall Street Journal article of about a year ago, their plant was going to cost $1.4 billion, so 4 times that. Now, they also would manufacture hydrogen, and they get the hydrogen credit from the IRA Act of a couple of years ago. However, they haven't broken ground yet, so we don't know where that's at. But the fact that they are out there and we and others believe they can make product the way that they're going to make it is an impediment to others to want to make an investment in carbon black capacity. So right now, other than that, in the Americas, there really isn't any significant expansion of capacity either in the Americas or in EMEA of carbon black.
And with that, I have a bunch more questions, but we're bumping up on time. But we really appreciate you being here, and we'll continue to follow the story, and I'll be following up with a lot more questions, and Jeff's around if anyone wants to follow up. Thank you so much, everyone.
You can both sit here. I mean, So it is now my pleasure to introduce the management of Rayonier Advanced Material, who this year is able to attend in person. Joining us is Delay Blomqvist, the company's president and CEO. Delay became CEO in May 2023 after serving on Rayonier's board since 2014. He has decades of experience in the chemicals industry, including as CEO of General Chemical Industrial Products, which was acquired by Tata Chemicals, where he then served as president. Based in Jacksonville, Florida, Rayonier Advanced Materials' main focus is on cellulose-based technology used in the production of natural polymers. These include specialty chemicals such as liquid crystal displays, filters, textiles, and performance additives for pharmaceutical, food, and other industrial applications. In addition, it makes high-purity cellulose paper pulp products used for a variety of specialty products, including lightweight, multi-ply paperboard, among others. The company also focuses on strategic investments targeting renewable energy projects and biodegradable ingredients. Rayonier has 65.7 million shares outstanding. Stock closed at $5.50 more or less last night for a 361 million market cap, net debt of $605 million, and a 966 million enterprise value. I will now let Delay bring us up to date on the company's projects and their progress.
Well, thank you, Rosemarie. Good afternoon, everybody. I am thrilled to have the opportunity to talk to you about the business. As Rosemarie mentioned, I've been with the business in one form or the others for a little over a decade now, most of it sitting on the board of directors in the last couple of years as the CEO. Just to give you a quick high-level view of the company, the business has been around for about 100 years. I know it's a business you haven't heard of, but it's been around for quite a while. And if you look at where we focus our energies on is really in three segments. Our core business is what we call high purity cellulose, or HPC, and represents roughly 75% of our revenues. It's produced in 3 plants around the world, 2 of them here in the States, down in the Southeast, and 1 plant in France. And in that business, we have what we call our specialty business, our CS business, cellulose specialty business, and then we also have our commodity business. Our cellulose specialty business, by far our largest business within the company, roughly 54% of our total revenues. And it goes in a myriad of different applications, which I'll talk to on the next slide. Commodities business is actually a business that we're trying to move away from. It's a business that historically we've had negative EBITDA on these products, and we've taken a number of actions in the recent past to start mitigating and reducing our exposure to that business. But again, great businesses in the sense that they've got great organic growth, particularly around the viscose business, which is a natural fiber for textiles. It's just that the preferred product is produced out of low-cost countries, and it's just a product that we can't compete on a cost basis. So it's a business that we deem as something that we need to mitigate. The other next business is a paperboard business, which is produced in Quebec. This is a business that has comparative advantages around what we call a 3-ply paperboard. It has a center ply that is produced at a very lightweight, high-yield pulp. So it has a surface area to weight ratio that's advantageous versus, call it, a more standard SBS board, which you find here in the States. And as a consequence, because of the lower weight, has certain advantages that has allowed that business to grow. The big mega trend behind that business is that it is sustainable packaging. And we believe that going forward that business has 4 to 5% inherent growth per annum. We don't consider it non-core, given that the vast majority of our assets and our expertise is really in the HPC business. And then finally, high-yield pulp. High-yield pulp is a commodity business. This is a business that the only reason we're really in it is because it's a key raw material into the paperboard business. We produce the high-yield pulp to be able to feed the paperboard plant to produce that particular specialized product for the company. Like the slide says, 4 plants. And then with respect to the future, we're working on and executing a strategy to build out what we call our biomaterials business. Number of synergies that are strongly, that we can strongly leverage off of that to grow profitability and expand margins. This is a business that will have strong co-product economics. We'll be taking waste streams from our cellulose specialty business, converting those waste streams into value-added products, so you get a strong byproduct economic credit from it, as well as the strong economies of scale that come from siting those plants at our existing cellulose business plants. So we're looking at 40% plus EBITDA margins in that particular business as we grow that out. Our products are in those things you consume every day. You wouldn't know it, but you eat wood every day. And it's really quite surprising where you'll find our products. So if you look at the first 3 categories there, the ethers, acetate, and other CS, this is our specialty products that we produce. And they go into a number of different applications, and in fact, many of the products we produce are actually designed and customized to specific customer applications. And in fact, we almost have 1 SKU per customer. That's how customized the products are. So in terms of substitution risk, relatively low. Qualification processes are very, very long, and as a consequence, very sticky in terms of our market position in these market applications. But again, even your phone that you got in front of you or the computer screen that you have in front of you, that has likely the acetate layer in there that came from our product and produced in the computer screen that you're looking at. Mentioned viscose and lyocell, a textile product, commodity product. Fluff, we consider it core. Strong growth applications around this. This is around the aging demographics around the world. It's really tied to adult incontinence and adult incontinence diapers, but it's also tied historically to feminine napkins as well as to baby diapers. It provides the absorptive material you'll find in those products. Paperboard, the big driver, as I mentioned earlier, is sustainable packaging. And then on high-yield pulp, really commodity business. And again, the reason why we're in that business is because, as you can see the center line there, it becomes an input into the paperboard business. Quick business overview, $1.7 billion in revenue. And you can see that on the revenue line, not real sexy in terms of growth, but that flat growth that we've seen over the past couple of years masks some, I would say, fairly dramatic changes within the industry. In 22, that's when we had the whole supply chain constipation throughout the world, where logistics was being tied up at ports and ocean carrier vessels were somewhat limited. A lot of customers were pre-buying material to make sure that they had the supply they needed to buy the product. 23 was the snapback. Once the ocean carriers got their act together, our customers found that they had far more inventory than they needed, and so we saw orders decline. And you can see that on the right side, upper right side, you see the orange segments on that. That represents the commodity production at our facilities. This is the production we don't want to do. And because of the lower demand on the CS production in 2023, we actually had to expand our production of our commodity business to keep the production lines at full capacity. What happened, though, as we were in 2023, late 2023, one of our competitors shut down one of their plants. in Florida. And then we would take proactive action in middle of 2024 to shut down another plant. And when that happened, capacity, a total of 10% of capacity was mothballed and taken offline. And you can see that in 24, revenue didn't go anywhere because we essentially walked away from a good chunk of revenue, but the orange segment of that stacked bar chart, you see it gets squeezed down to a total of 6%. And that's exceptionally important. And you can see that in the bottom left. You see that the EBITDA margins grew 60% from 2023 to 2024. A large part of that is being driven by the fact that we walked away from that commodity sales that you see in the orange up in the upper right. And that was, and why that happens is that business actually has a negative EBITDA. So walking away from that business, closing that capacity, allowed us to focus all of our assets primarily on the CS business where the margins are very, very healthy. And a large change that you see in the 24 number from the 23 number is being driven by that action. Last thing I'd point out on this chart is just the pie chart on the bottom right. We are an exporter. We export a lot of our materials around the world. And obviously in this uncertain world, as it revolves around tariffs and all that, there's a potential risk there. And I've got a slide that'll talk about that in some detail. Initiatives, a lot of words on this slide. I'm gonna go through everything on here. Just want to highlight the priorities as I see it for 2025. Since I've been in the CEO seat, I've been focused on reducing debt. Not leverage, but debt. I think the total debt level, the quantum of debt is too high to go through the full cycle of the business. So we've been focusing on reducing debt. Last year, we took down debt roughly $72 million. This year will be somewhat limited because of our new credit agreement. So we'll be stuck to the level of amortization, which will be roughly around $20 million. But our focus will be to use free cash flow to pay down debt to a point by which we feel comfortable that even in a down cycle, we should be fine with respect to operating the business. Optimizing the assets, I already talked a little bit about what we're trying to do there, about changing the mix of sales and the mix of production away from commodities and towards specialties. The shutdown of Temiskaming last year was a big part of that. We believe that growth in the ethers business and in the other CS segment will offset any decline that we may experience in the acetate. Acetate, a good chunk of that is tied to tow, which goes into cigarettes. So there's going to be a natural secular decline in that business. But we believe the growth in the other two segments will more than offset the decline we expect to see in acetate. So as those businesses grow, we should see less commodity production going forward. In terms of our growth, biomaterials, again, I've already talked about what we're trying to do there. Our first plant came up and running in April of 2024, a bioethanol plant we built in France. It's up and running. EBITDA last year, $3 million EBITDA, not much because we're going through the startup phase. This year, we expected that business to generate $8 to $10 million of EBITDA. So we're seeing good growth on a relatively small plant. But we've also got a number of other opportunities there. And in fact, we've been able to get access to very low cost of capital. Because we have an operation in the EU, because we have an operation in France, we're able to get access to very low cost, I'll call it green capital, where we can get this capital to build these plants. And in fact, the plant we built in France, we got at an interest rate less than 2% to build this plant out. In fact, the total capital from an equity perspective that we invested as RIME into that plant, a $40 million project, and I think we spent $7 to build this thing. So if you look at it from a return on equity perspective, very, very, very good. And we expect that going forward as we build out these plants, we'll be able to we will have the access to such capital to build these plants out and therefore drive significant value for equity. And the last point I want to make on this slide is we're changing our segment reporting this year to be more in line with our actual strategy. to provide transparency to our equity and our investors. So you'll have a segment just on our core business of cellulose specialties. You'll be able to see the profitability. You'll be able to see the revenue growth. We have a segment on the commodities, which we're trying to get out of, so you see whether we're having any success there in terms of mitigating and reducing our exposure. The growth of the biomaterials will be shown in its own segment, and then high yield and paperboard will have their own segments. One of the big questions I'm sure that a lot of people are asking is what is our exposure to tariffs? We are a big exporter. In fact, I think we're the largest exporter out of the port of Savannah in Georgia. So we're material, and therefore the exposure to potential retaliatory tariffs is fairly high. But I would say that when you look at our core business, our cellulose specialties and even our cellulose commodity business, because of the structure of the industry, our ability to pass on the cost of those tariffs to our customers is really high because the industry is operating at a very high capacity utilization rate. And as a consequence, there really is no option for our customers to seek substitutes. So our mitigation strategy there is really to pass on those tariffs to our customers. Where we are exposed is our paperboard business. And in my call last week with the analysts, as we gave out earnings, was that the worst case scenario was about $42 million impact if the full 25% tariff on Canadian imports was affected. That would, given that we sell 70% of our volume of paperboard from Canada into the U.S., that could be material. So we've launched the effort to mitigate that. And the guidance that we've given, the $215 to $235 million of the EBITDA, includes the worst case scenario of tariffs on the paperboard business, but also our mitigation plans. And remember, our year for 2024, our EBITDA was $222. So even with the threat of the tariffs, we believe with high confidence that we'll be able to exceed our EBITDA for last year, even with the threat of tariffs on the paperboard business. One of our key strategies that drove our decision to shut down the Temiskaming HPC plant was a strategy that we've employed called value over volume, trying to get value for our specialty products instead of trying to grab market share. And this graph shows you how we're able to do that. So before 2023, you see that the excess capacity was around let's say 300,000 tons per year in the industry. After the shutdown of Foley, after the shutdown of Temiskaming, it's now down to 0.1. So over 2/3 of the excess capacity was taken out of the industry. So the capacity utilization in the industry is now in the 90s. The other important point to make here is that since we're the only one with multiple production lines, all of our competition has a single production line, we're the only one with multiple, and we own 66% of the market share, we own all of that excess capacity, which means we are the ones that own the pricing power. So our intent is to continue to push value. We'll get to 0.1 in time as ethers and as other CS demand grow, and we're able to move away from the commodity business as we talked about earlier. Important chart here. This talks about our capital allocation. The important point to make on this is that we strictly adhere to, I would say, a very high investment threshold. Our projects, when we spend our discretionary capital, is that it has to provide a 30% ROE and a 2-year payback. And if it doesn't, the project doesn't get funded and it's put on the shelf for future consideration. We've got a bunch of projects that are lined up to be invested in that we believe achieve this threshold. So we got on this chart, you see a couple of categories. One is biomaterials. Our biggest investment, again, huge leverage off of co-product economics or byproduct economics as well as economies of scale. Total of investment over the course of the next 4 years, about $100+ million. But we believe that that's going to generate roughly $55 million in EBITDA for the business in terms of growth. The other segment called Cellulose Specialties is really around cost reduction, focusing on our existing facilities by applying new technologies around automation, AI, and labor productivity. The plan is that spend roughly $39 million and get $31 million of EBITDA out of it. We have a backlog of projects that we can get after. So if some of these projects don't meet that investment hurdle, we'll put that on the shelf, bring one forward, and continue forward. So I'm highly confident we'll be able to achieve, by the time we get to 2029, a growth of EBITDA of roughly $80+ million with very, very high return potential. Last slide. Leverage, has gotten down to, I'd say, a very manageable level. We're below 3 now, roughly 2.7 when we came out of 2024. What I'm really focused on is that margin line, which is that dark line going up to the right. Last year, we increased by 500 basis points. We expect that will be somewhat muted over the next couple of years, but it will grow because, again, we have the ability, due to the tight supply situation in our core business, to push value over volume. We believe that ethers and other CS demand growth will offset any kind of decline we'll see in cigarette consumption. And so we'll actually see the benefit of reducing our commodity exposure as a result of that. And then the growth of the biomaterials business, given the 40+% EBITDA margins on that, will have an impact on the overall enterprise margins. Oops, kind of appendix. You're not going to see the rest of it. So that's it.
Thank you, Lyle. That was very informative. I was wondering, first of all, if there is, to start off, any questions in the audience. Yes, there is one before I start.
What plans do you have if a recession occurs? What would be your strategy then?
Couple of points I want to make on that. You're going to find that many of our products are recession resistant. They will be consumed whether or not GDP goes down as a result of lower economic activity. You can see that in the end uses that our products go into: food, pharma, some applications around personal hygiene, and so forth. But it doesn't mean that we wouldn't see some exposures. So if that were to happen, of course, and CS demand were to come down, we would fill up the capacity of the facilities with some of the commodity to keep the plants running at full capacity. We would continue to keep pricing where it's at. We wouldn't chase share. And instead of chasing share, we would keep our competition sold out, and we would fill up the freed up capacity with commodity production. That would cause, obviously, EBITDA to come down a little bit. To offset that, we would go through the efforts of reducing our cost of production by either accelerating some of the high return investments that I've kind of alluded to already, as well as possibly reducing cost on a more dramatic basis if we had to. But we have, because we have multiple sites, we have the ability to swing capacity between, or production between the sites, and if it really got severe, there's a potential of again, constraining supply if needed to maintain the value of our business.
Here is another question in the audience.
Yeah, hi. You mentioned biomaterials opportunities specifically, and the paper mentions a biodegradable demand. So can you dive a little deeper into that? Like, what either consumer or commercial demand particulars are driving the biomaterials? If it's not just the desire for biodegradable substitutes for legacy type things from the past, or is it something else specifically driving your particular opportunity in that marketplace, in that niche?
Yeah, and that's a great question, and it's an exciting opportunity for us in that The biomaterials business is really, just to give you the basis of it, is we're pulling out and using as a feedstock the material that was freed up from the cellulose process. This is the sugars, this is the lignins, this is the bark, this is whatever else is left over, the hemicellulose, and we'll separate those out and make products out of them. Initially, those products are going to be focused on what we'll call biofuels. So, for example, we take the sugars out and we ferment those sugars, just like you would find in a brewery. Same process with yeast and the whole thing, and create ethanol. And it's a bioethanol. It's got a circular economy to it. And because it's not a food source in the EU, they consider that a generation 2 bioethanol, and there's a premium for that product. So we built a plant in France. We're planning to build a plant in Florida of similar size, and that would have the bioethanol will end up in the fuel streams of primarily autos initially, but could become a feedstock for more sustainable fuels like SAF or sustainable aviation fuel in the future. There's other products that we can make, for example, a CTO product or a crude tall oil product from some of the extracts we get from the process, and that would go into things like biodiesel. It's a feedstock for biodiesel. We also are going to strip out the cellulose, the heavy cellulose out of the waste stream and make a prebiotic animal feed out of it. So those are the things that some of the innovation and some of the work that we believe will help us. And the important point to make about it, these are markets that exist today. I don't have to create a market. We're going to be a drop in the bucket with respect to our size relative to the market itself. So we believe our entry into the market will be relatively seamless.
Yep. There is another question in the back.
Yeah, you talked about reducing debt. Do you have a target? Your ratings have been dropped to, I think, B- at this point.
It actually was raised to B-.
I'm sorry?
It was raised to B-, says Delisle.
Right. So but I mean, it used to be much higher. So let's years back.
Yep.
So can you talk about what the target is, and are you planning, and what, if any, leverage level do you feel comfortable with?
Yeah, well, leverage I think I'm comfortable with already. The 2.7, our goal is to get down to 2.5. It's really not a leverage question. It's really a quantum of debt, which is really an issue around fixed charges. Our fixed charges right now sits around 160, something like that. A large part of that is our interest expense. I want to get our debt down to a point where that interest expense, instead of being around $80 million, is closer to 50 or less in terms of the use of cash. So in terms of long term, the goal is that I would love to get our total debt down below $500 million. One, to free up our fixed charges, but also to make sure that our leverage never becomes a problem throughout the cycle of the business.
Do you think you can get to that 500 million without selling the paperboard and high-yield pulp business?
It would take time, of course, because we do generate free cash flow. But the quick solution is to sell the non-core assets, and if I were successful in doing that, that would take care of the problem.
Do you see any interest out there for those assets, or
we certainly did before the whole tariff discussions began. The uncertainty around the tariffs have essentially put those discussions on ice for the moment. Once we get past and get some certainty back in the business, I think those discussions can begin again.
And still following up on that, do you see that those tariffs, which may hurt you, probably will, not may, but could they also hurt the imports from the Chinese cheap material and therefore help in that other category?
Yeah, we really don't have a threat from China. with respect to paperboard or any of our products into North America. Our threat is European, and it's primarily the Scandinavian products coming into the East Coast of the United States. If there was a tariff obviously put on imports from Europe, then that would be helpful. We're planning that that's not going to happen. And so what our strategy really is around is to buy some time in terms of covering off the cost of the tariffs until we get the qualification process to its conclusion in Canada, and then swap out U.S. share for Canadian share in the next year, 18 months is really the long-term strategy, and I'd say the permanent strategy for dealing with the tariffs.
So in Canada, you have a facility which mostly exports into the U.S., if I understood properly.
That's correct.
How difficult would it be for you to actually sell those products into the Canadian market, or is there just too much competition there and it is unlikely?
With respect to our particular product, which is called FBB, folding box board, we're the only producer in North America of that product. Our competition is from SBS, which is primarily from the U.S. producers. The barrier we want to, and we've been successful to date, is convincing the Canadian government to put out a retaliatory tariff of 25% on anything in from the U.S., both on substitutes as well as direct product, to essentially protect the Canadian market. That would buy us the time and then give us the opportunity to make the share swap.
So looking at innovations on the cellulose business, what type of materials can it replace, and how will they add value and make your customers' products more efficient?
Well, one of the things we target, and it's really a mega trend, and we talked a little bit about that in paperboard, is that there is a strong push for more sustainable packaging, more sustainable products. So what we focus on in terms of innovation is attacking those products that are out there today that are made from fossil fuels or made synthetically. And so that's one of the areas we see as rich with opportunities, something that certainly is available in paperboard as well as in cellulose. A couple of ideas that we're pushing hard, that we're pushing to the market now. One is a odor control fluff that goes into, as I said, into personal hygiene applications. When the product is insulted, that it gives off a similar to Febreze, and essentially captures the odor and keeps the smell at a low level. So those type of applications where we're enhancing the already inherent advantage, sustainable advantage of the product, is something, one of the things we're doing with our products. Other applications just continue to be around how can we provide a product that performs better than some of the synthetic products out there.
Delisle, thank you very much. Once again, I am over time, and and we'll continue on, but we really appreciate your joining us, and it was a very informative presentation. Thank you.
As we're running a few minutes late, I'll jump right in. So hello again, everyone. Last but not least, to cap off the symposium, we have Lithium Americas joining us virtually. Lithium Americas, based in Vancouver, BC, was formed through the separation of predecessor Lithium Americas into two public companies, Lithium Americas that we're hearing from today, and Lithium Argentina. The company is committed to developing the Thacker Pass project in Humboldt County in northern Nevada, which hosts one of the largest known lithium resources and largest lithium reserve, proven and probable, in the world. Thacker Pass is owned by a JV between Lithium Americas, which holds a 62% interest, and is the manager of the project, along with GM, which holds a 38% interest, which that JV was formed following GM's $625 million investment, which closed in December 2024. The company is focused on advancing this project through phase one towards production targeting capacity of 40,000 metric tons per year of battery-grade lithium carbonate. That capacity is expected to reach a total of 160,000 ton annual capacity over an additional 4 phases. And the company has an offtake agreement with General Motors for 100% of the production volumes from phase 1 for 20 years, plus 38% of phase 2 production volumes for 20 years. And GM has the right of first refusal on the remaining of phase 2 production volumes. Lithium Americas has around 220 million shares outstanding, trading around $3 for a $660 million market cap. Net cash as of September 30th of around $340 million for a $320 million enterprise value. Joining us remotely is CEO John Evans. John was CEO of predecessor Lithium Americas before the split from May 2019 until the split when he became CEO of New Lithium Americas. He has over 20 years of experience in operations and management, including a prior role as the vice president and general manager of the lithium division of FMC, which became Livent. Also joining him is new CFO Luke Colton, who joined LAC just 2 months ago, but brings significant mining experience over 2 decades, and most recently as CFO of Minova International. We're happy to have John and Luke joining us via Zoom, and I'll let them start off with an overview of LAC before getting into Q&A.
Thanks, everyone. And actually was just out, Luke and I were back out at site actually 2 days ago, so even the picture that you see here has changed quite a bit as we're in active construction right now. Just to give everyone an overview of the company, I appreciate the summary. You know, who are we? We are the largest known lithium deposit in the world. Actually, it's in northern Nevada, and you can see the inset there in Humboldt County, up near the border of Oregon. Our project area is the darkened area in Thacker Pass there that constitutes our operating area here, and actually it constitutes where we would do actually additional expansions. We could do 5 expansions on the project scope that we have now, and the data that we published earlier this year puts it ahead in terms of a reserve and resource well ahead of anything else in the world. We're funded, as you mentioned, we have our capital stack is made up of a Department of Energy ATVM loan for $2.26 billion. The capital portion of that is about 1.96. The rest is interest during construction. The General Motors, who has invested in us via a JV structure, which actually changed a little bit. Originally was going to be just an investment in common shares in the company. The second phase of that investment came in directly as a JV partner. So in total, cash put in the company is $750 million, and then on top of that, they're providing and furnishing a $200 million zero interest line of credit during construction, which is actually satisfies one of the requirements for the loan, where we have to have extra liquidity above and beyond even contingency during the construction phase. We are low OpEx. Oh, and I almost forgot, Orion Partners is the third leg of that. We recently announced an investment of up to $250 million of Orion. We've taken $220, and there's an ability to draw another $30 once we get into the project with them as well. So well funded. I'll talk a little bit about those partners. They're all well known for GM obviously is an OEM, and Orion is an active investor in this space for critical materials, minerals in general. To low OpEx project, so even in today's pricing environment, which is challenged, we would be cash flow positive with OpEx of about $6,300 a ton. We have an offtake agreement with GM where they have the rights on an annual basis for up to 20 years of the project for phase 1. That's governed by a pricing agreement, which is actually built into the loan, where there's actually a floor price. There is no ceiling, but there's a effective discount depending upon what pricing is in the marketplace. So they are hedged against very high prices in the past, like we saw a few years ago when the price of lithium was about 6 times what it is today. And a very experienced board and management team. Luke joined us, and his experience, you can see in his bio, is quite extensive with Rio Tinto and large projects like this all around the world. Along with a management team that's been built to actually not only build but operate this asset. We consider ourselves as much in the chemical industry as we do in mining. The bulk of the capital for this project is actually to build conversion and purification. When the product leaves the site here, it goes directly actually to a battery manufacturer to be put into a cathode. It's a large project. We had the governor join us actually 2 days ago, and our congressman will be peaking at about 2,000 jobs. That's actually assisted by a project labor agreement with the North American Building Trades, which is part of the AFL-CIO. We have completed the bulk of the detailed engineering, so we're approaching 60+% now of final engineering. And when you build projects like this, typically when you FID a project, you're at about 30 to 35%. So we're well advanced and very confident now, just given the advanced nature of the engineering, which in order to do that, you have to start spending significant amounts of capital to start locking in time in fabrication shops and so forth. So we've been running this basically in parallel, and we've invested actually quite a bit of money in this project, several $100 million at this point. Talked about the collaboration with GM. We're also collaborating with the local communities, whether that be the nearest town, which is about 8 miles away, even the Indian reservation to the north, the Fort McDermott Paiute Shoshone tribe, which is about 50 miles away to the north of us. The process has been backed by years of research and development, and actually by an active full-scale pilot facility. We've tested steps of this process at scale, such as beneficiation, and the rest we've been able to operate this facility in miniature, if you will, for the entire flow sheet. And it is a project that we're very proud of from a footprint standpoint. We recycle 85% of the water that we use. Our power is half of it's generated by waste heat from our reagent plant, and the other half actually is wheeled in via the grid from Pacific Bonneville Power, which is the power supplier in the Pacific Northwest. That's all hydro-based, so we're actually carbon neutral. It's been a long journey here. You can see this project goes back to 2007 and actually goes back to the early 70s. It was discovered by Chevron looking for uranium. They didn't find uranium, but they found lithium, mercury, and other things in and around the region. The company was called Western Lithium. It merged with Lithium Americas in 2016, and a new team came in, and we basically put together a process that's very economic. Got all the information we needed to start preparing for permitting. We went through all the permitting regime where all of our federal and state permits are in place at this point, so we have no litigation issues or ability restrictions to operate. You can see here the joint venture agreement with GM announced last year, but that actually goes back to an offtake agreement that was done early in 2023. Our updated resource and reserve, which was done early this year, which really highlights the unique and world-class nature of this deposit, whereas the U.S. actually has the largest lithium deposit in the world. And then finally, the final investment by Orion Partners, Resource Partners, which was announced about 2 weeks ago. Our partners, and really this makes up our capital stack. So we were the largest loan that's been actually closed now. Our loan was closed in early October of last year and sits at the Federal Credit Bank with Citibank at this point. We expect to draw sometime in the third quarter of this year. And I know you'll ask me questions, am I worried about that? And the answer is no. We're actually playing exactly where the administration wants, where their priorities are all the above, with oil, gas, critical minerals, which you hear in the news about every day now. And this project is right down the middle in terms of what the administration is focused on. We were actually permitted during the Trump administration. We were protected in court by the Biden administration and funded via a bolstered LPO office. GM came in the middle of that as well with an original investment of $650 now, as you can see, up to $945 million, so they doubled down. And then Orion has joined here at the end with the final capital that we need to allow us to be fully funded to move forward in full construction, which we are now at this point. A lot of things, we've actually put a lot of thought in this project. The first one, which might be unusual in some industries, is actually a workforce hub. We are providing actually housing for our workers during the construction phase for up to 2,000 people. That's actually assisted by the project labor agreement that we have with the AFL-CIO and the North American Building Trades. So we'll be housing workers, feeding them, busing them to site, and they'll have a place to stay. Given the area that we're in is relatively rural, the city that it's located right outside of is Winnemucca, Nevada, which has about 10,000 people. The county, though, and I know you're all East Coasters, is the size of half the state of Connecticut and has 16,000 people in it. So this allows folks to come from far around the country, work 3 weeks on and get 1 week off. The facility's right off of Interstate 80, and it's about a 45-minute drive to site, but it's something what we wanted to put in, number one, to attract a good workforce, but two, not to put undue strain on the community, just given hotel room availability and just housing in general, which is a problem across the country now, where it's in short supply and very expensive. We have completed just about all the excavation at this point. All the pads are in place to start pouring concrete for all of the process buildings, and that'll start over the next few weeks. We have a batch plan on site for concrete, all the utilities, roads. We're fully mobilized at this point. All of our long lead time equipment has been awarded to safeguard the timeline, but also to lock in pricing, and that continues. And then, as I mentioned before, the detailed engineering is well advanced for a project at this stage, just given it's well ahead of construction, which is in the teens at this point in terms of progress, whereas the engineering is well outstripped that, which helps really de-risk the project going forward too. These are some pictures here. Again, these are sort of old because even as of this week, the one on the upper left, we have all the pad sites have been put in place. You can see the batch plant in the middle. You can actually, from one part of this, from a viewing platform to the north, you can actually see the entire sort of footprint for the plant already laid out with all the building foundations already excavated. And then on the bottom right, you can see the workforce hub, which now we're placing housing units on top of all those piers. And as I said, that workforce hub is about 45 minutes away from the production site. The process itself basically borrows from what's practiced currently. What's different up front is the source of the material is in a specialized clay material that's left over from a major supervolcano which erupted about 16 million years ago. It's the highest known lithium concentration on Earth. We have lithium that occurs up to 1% by weight, and it's a very easy beneficiation process that we use exactly like the phosphate industry, where we put the ore in slurry. It's friable, and you can break it apart with your hand, separate it based on particle size, and concentrate it up to 1%. Thicken it in centrifuge to take out the extra water, which we recycle, leach it with a reagent that we make on site, and basically then run it through a purification process, which steps 3 through 5 look exactly like a spodumene or brine-based purification process that are running all around the world. All the equipment that we have is operating around the world today. Nothing is oversized or largest ever built or anything like that. It's all basically off the shelf and relatively easy technology because the resource is very good and the chemistry is actually quite simple for us to convert and do the mining and conversion all in one spot. As I mentioned, OpEx, you can see we are at about $6,300 a ton, and where we are on the cost curve based on global demand and average pricing today. So it's a world-class deposit, a first quartile type deposit that can survive in tough markets like we are today. It's very large. What we have depicted here is this: we are operating all 5 phases. Our first phase is only 40,000 tons, so it's a little slimmer column than that, but it rates and lines up very nicely with the best resources in the world. And again, it would represent the U.S.'s largest lithium chemicals processing facility that it's ever had. We do produce today, but only a tenth of what phase 1 of this project would actually be putting out. The team here, as I mentioned, Luke is with us and joined me this morning or this afternoon. In my own background, I come out of the chemicals industry. I started my career with General Electric. I spent 13 years there in specialty chemicals and in their engineered plastics division. I've been in pharmaceuticals. I've been in lithium for 5 years before that, and even in private equity. My experience has been mainly around chemical and process industries. Richard is our owner's team lead and comes from a very illustrious career at Fluor, building mega projects around the world for almost 30 years. And he's backed up on the board by Phil Montgomery, who's the former head of capital projects for BHP, which is the largest mining company in the world. And then our chairman, Kelvin Jashinsky, was the former president of Barrick and also Anglo, which are major mining companies today. I think Barrick's the largest gold mining company in the world. This is an important investment for our country. You can see some numbers on here. I'm not going to go read them off, but from the Department of Defense standpoint, they spend several $100 million a year on rechargeable batteries. Every drone, every Starlink satellite, every submarine, fighter jet, and then to go on, beside this, every data center, your cell phones, our computers are all powered by rechargeable batteries. So it's a strategic imperative for the U.S. There is a lot of capacity going in right now in the U.S. in terms of battery facilities, but also cathode facilities and the rest of the supply chain. While we'll be producing 40,000 tons a year, that's not going to be able to satisfy all of the U.S.'s demand by any stretch. When we get into production, it might satisfy 15 to 20% of North America's demand for refined lithium chemicals. Today, over 70% of that all comes from China. So it's a first step forward to reshore this critical material, but it's by no means alone are we going to be able to switch the how it works today. There'll be more investments needed, hopefully by us as we do further phases, but hopefully other assets around the U.S. and Canada are developed as well. And then our timeline here, this is sort of where we are today. You saw earlier, this goes back, it took 10 years to get to this point. At this point now, we're in full construction. It'll take us the next 2.5 years to build this, get it into mechanical completion, and to start ramping up at the end of 2027, all throughout 2028, and then to be providing General Motors with the products they need to support their battery business. But also as joint venture partners, we have the ability, if there's if they don't need all of the material on an annualized basis, we're qualifying with about 7 other folks that in the business right now that we'll be able to sell to. So it's great that we have an offtake, but we also have options as JV partners to maximize output out of this facility on an annualized basis. I think that's it.
Okay, great. Thanks for that overview, John. We'll start off. We have a question in the back right to start.
Hi, can you give us the terms of the convertibility for the Orion notes?
It's a 5-year note. So at the end of 5 years, of course, we have the ability actually to buy them out. I think that's after 2.5 years. Otherwise, as a 5-year, it would convert to equity. I think the PIK is 9.87%. I'd have to go back and look. So actually below 10%, which is good. As you know, there's also a royalty/production payment with that as well. That added about $100 a ton to our OpEx cost. Orion is backed by pension funds and by sovereign wealth funds primarily. So their model a little bit different than private equity. They guard against the bottom side so that they have an annuity, if you will, whereas on the upside, that production payment agreement actually reduces as price goes up. So,
but I mean, is it convertible into equity at what strike price?
It's what is it, $3 and I want to say 87 cents.
387. Okay, thank you.
Okay, and to piggyback on that, with that last investment and the investment from GM, I think that was the last equity component you needed for the Department of Energy loan. How is that loan structured, and how are you able to take advantage of that going forward through the construction process?
So our first draw is later this year in the third quarter. It requires us and JV or GM as our JV partner to spend and or commit 95% of the capital that we brought to the project. At that point, we start to draw off the government credit facility, and we do that until the end of the project. So your money goes in first, and then we meet on basically a biweekly basis with the Department of Energy. Every quarter, we do a roll-up with them as well on spend and how much capital has been spent. The process actually to draw is not a political one. So our loan is closed and sits at the Federal Credit Bank. It's a very mechanical process where you basically meet the criteria and then you start to draw. The loan is drawn on a monthly basis based on a punch list, if you will. So we have a model going forward through the whole project. 30 days before we draw, we essentially have a somewhat itemized list of major areas. So it's not line by line, but major areas, whether it be rent equipment or overhead costs for the joint venture, that are submitted to the government and become the basis for the amount that's drawn on a monthly basis.
All right, great. And you mentioned all litigation and permits in place, the construction for phase 1's underway. We appreciate following the lithium industry for many years, how difficult that is. And you're on track for construction to be completed by late 2027. Yes. What milestones should investors be looking at for now, including the FID? And can you take us through the flow sheet of getting to full production?
Yeah, the FID is, that's a mechanical process with GM that we're almost wrapped up with. They had to sign off on things, and that's been well underway. So I wouldn't consider that a milestone as much as obviously you're all going to look at the first draw to make sure that there's no issues there. We're not worried, but I know a lot of folks look at the different landscape and that we have currently. So that'll be one. We will have production, first concrete, which will be this spring. So kind of going back a little bit, that'll be another milestone for us as well. And then as you get into 2026 and 2027, there'll be major construction milestones. First, steel in the ground, concrete pours are completed, major piping in place, once the steel work gets in place, all the way to 2027, where you'll have unit commissioning complete. So we'll do individual units commissioned. We wet commission them with water, and then hand them over until we do a final mechanical completion handoff in the fourth quarter of 2026, so we can fire the entire circuit up.
Okay. And then you mentioned it in the presentation. We're very familiar with hard rock and brine production, but your source is clay. Can you take us how that process differs at all, and how you mentioned you're going to fall low on the cost curve, but where you would fall?
Yeah, we're in the first quartile. I think when I projected up, I think that's on our corporate website at around $6,300 a ton. So it's a mixture of both. It's a little bit closer to hard rock. The difference is that I don't have to use a lot of energy, so crushing, grinding, and there's no calcining required, which requires to heat an ore up to change its crystal structure. You have to heat it up to 15 to 1600 degrees Fahrenheit. We don't have to do any of that. The lithium occurs within the ore, but it's loose. And that's just because all lithium comes from volcanoes. In our case, it's a couple 100-meter thick, deep layer of sediment from a volcanic eruption that's stuck in place. So it almost looks like a sand pit. It's a relatively shallow mine. It's only 1,000 acres, and it's about 400 feet deep at the deepest spot. Once you get past the beneficiation, it looks pretty much exactly like a spodumene, a hard rock deposit would in terms of handling after that. The leaching's the same, and the purification on the last three steps is actually, they're all the same for any type of deposit you would have to get it to a battery-grade product. So what I would say about this project, I've had a lot of folks, especially I'll say from Australia, because that's hard rock country there. Firstly, if you look at deposits like this, which are large, easy to mine, and folks will look at concentrations. Concentration's high here, but it's very shallow and easy to mine. So it's like laterite deposits from nickel in Indonesia today. That was a deposit that folks looked at and said, well, it's never been done before. It's done so well, it's killed the nickel industry in Australia, that they do it via hard rock. So, there's nothing that we're doing here that's different or new in terms of technology. There's no black box here, no equipment that's had to be developed, specialized for this deposit. It's just the geology is very easy to deal with. And it's backed by work that we've done with Stanford University to understand the crystal structure here. And literally the beneficiation up front is really simple. That's what makes the cost low, and that it's low energy, the low temperature, and we don't have any exotic materials in construction either. There's no titanium in this. There's no high heat, no high pressure steam. We don't have any of that. We don't even need natural gas. So we're just lucky that the geologies are very good.
All right, great. And then we've had a very weak pricing environment in lithium for an extended period of time now. It might work out great for Lithium Americas, being the timing of your end of construction. But just wanted to get your thoughts on lithium pricing. What needs to change to bring things back to normal in the market, and how does that change your thinking on phase 2 and beyond with Thacker Pass?
I think economics is going to do its thing here, where you're seeing major cutbacks by the current producers who even themselves are having problems with financing today. There isn't a lot of inventory in the system at this point. Pricing needs to be to a point where it's in the high teens or low 20s to get major capital off the sidelines from private sources, or for the majors to come back and to be aggressive again, whereas Albemarle, for instance, at one point was over $4 billion of capital at work. I think the challenge in this sector, and your chemicals folks, and I am too, the mining industry is used to building through cycles. And the chemical industry, if you're a large chemical company, people buy chemical stocks because they're predictable in a lot of cases. You have a higher, you might be trading at 8 or 9 times versus the mining industry is 2 or 3 times. Chemical companies, positive cash flow is key, and dividends are key. When you get in environments like this, the companies in the lithium space are small. Nothing against Albemarle, but I had a division of GE, which was half the size of their whole company, and so they're fairly small. They can't put $4 or $5 billion at work, go negative cash flow, and say, just wait, it'll be great, just wait. So them, SQM, hell, even Rio Tinto got involved now. Rio Tinto couldn't even do a $6 million share raise. They had to go to debt to fund their purchase of Arcadium. So it's all starting to hit home now. Pricing will respond. Is it going to go back to $80,000 a ton? No. I think that was a bad thing for the industry. But you need to be in the high teens and low 20s for any of those companies to actually start to put that kind of capital at risk again, especially chemical companies. And the companies in this space outside of Rio who's getting in are really small. There's no Dows, there's no BASFs, there's no Air Products, things like that are big firms in here. Oil companies are biting around the edges, but I think that's a long ways off before they get heavily involved.
Okay, well, that's our time, but I just want to thank John and Luke for joining us. I know you wanted to join in person, but we're very happy to have you virtually, and hopefully next time. And hopefully I can get out to visit the mine at some point. But thank you very much, and we'll be looking forward to the progress of Lithium Americas.
Thanks a lot. Appreciate it.
So everyone, that concludes our 16th Annual Specialty Chemicals Symposium. As our Co-CIO, Chris Marangi, mentioned earlier, we host a series of these throughout the year. We hope you can join us back here in the next 2 weeks for our 11th Annual Waste and Environmental Services Symposium on April 3rd. On behalf of myself, Rosemarie Morbelli, and all of our team at Gabelli Funds, I just want to thank everyone for your interest and participation. Thank you, everyone.